You wake up, go to work, pay bills, and repeat, year after year. But what if I told you that just $60 a week could be your ticket out of the 9-to-5 grind? In this video, I'll show you and Josh 3 solid dividend stocks that can do just that. Replace your income step by step. I will show you stocks that pay over $5,000, $7,000, and $9,000 in monthly dividend income. And in the end, I will show you a combined portfolio of these 3 stocks that will provide the same level of dividend income with less risk while still reaching over $1 million in valuation. Everyone dreams of quitting their job, but let's be real, you need a solid plan to make that happen. The big question is, how much money do you need to replace your paycheck? Some people can live comfortably on $5,000 a month, while others need $7,000 or even $9,000 to maintain their lifestyle. Now, let's say you have a 3% dividend yield. That means for every $100 you invest, you earn $3 per year in dividends. To make $5,000 a month, that is $60,000 per year, you'd need $2 million invested. For $7,000 a month, or $84,000 per year, you'd need $2.8 million. And for $9,000 a month, or $108,000 per year, that's about $3.6 million. Sounds like a huge amount, right? But here, compounding works its magic. You can reach the same goal if you have time on your side, and with much less investment. In fact, you can reach the same dividend income goals with just $60 a week by investing in the right dividend stocks, reinvesting the payouts, and letting time do the heavy lifting, without needing millions up front. Let's break down 3 dividend stocks that can help you hit these numbers and achieve financial freedom faster than you think. At number 3, I have Prologis with a ticker symbol PLD. As the global leader in industrial real estate, it owns and manages warehouses and distribution centers, essential infrastructure that keeps e-commerce giants like Amazon and FedEx running smoothly. Think about it. Every time you order something online, chances are it passes through a Prologis facility. With warehouses in prime locations worldwide, the company has a steady stream of rental income from long-term leases. And as online shopping continues to grow, so does the demand for Prologis properties, making it a strong pick for investors looking for stability and growth. One of the key reasons why Prologis stands out to dividend investors is its history of consistent and growing dividends. While Prologis' current dividend yield sits at 3.18%, the company has built a strong track record of increasing its payouts over the years, with a 10-year dividend growth rate of 11.27%. This is important because it shows not just a commitment to rewarding investors, but also the company's ability to generate profits and maintain its financial health. Even in uncertain times, Prologis has been able to sustain and grow its dividend payouts, which is crucial for those looking for consistent passive income. Prologis has a solid balance sheet, with total assets projected to reach $95.3 billion by 2024, and its net property value alone standing at over $78.5 billion. This means that the company is backed by substantial real estate holdings, making it financially robust and able to weather market fluctuations. Even with $36.7 billion in liabilities for 2024, Prologis is in a good position, with the cash flow from its properties more than sufficient to cover its debts and continue rewarding shareholders with dividends. This financial strength adds to its appeal as a long-term investment. Prologis doesn't just deliver a stable income stream, it also offers capital appreciation potential. Over the last decade, Prologis has seen a 184.78% return, which outpaces many other stocks in the market. While it has slightly underperformed the S&P 500, its dividend growth and stability make it a strong contender. Even in the face of market volatility, it has managed to hold strong and continue delivering for its investors. The future for Prologis looks promising. As for projection, as I said, it has a dividend yield of 3.18% with a dividend growth rate of 11.27% and an average annual share price appreciation of 8.55%. If you and Josh were to invest $60 every week in this stock, your investment could grow significantly over time. After 1 year, you will have $3,120 for investment. After 10 years, that investment would be worth about $56,000. Fast forward to year 20, the investment will be valued at $252,000. And by the time you hit the 30-year mark, you will have $1.05 million in value. Along the way, you would also be earning dividends, $63,000 annually after 30 years, which equates to about $5,250 per month. These are very good returns, but there are better options to come. In a couple of minutes, I will show you a stock that will pay double the dividend income of this one. In the end, I'll show you a combined portfolio of the 3 best stocks that will turn a $60 per week investment into a portfolio valued at over $1 million and paying over $7,000 in monthly dividend income. Next at number 2, I have Illinois Tool Works with a ticker symbol ITW. This is a company that may not always make the headlines, but it is an absolute powerhouse in the industrial sector. With a diverse portfolio, ITW is involved in everything from automotive and construction to food processing, welding, and many more essential industries. The company manufactures tools and equipment that are indispensable in day-to-day operations across multiple sectors, making it a key player in the global industrial landscape. ITW's products are used in everything from large infrastructure projects to smaller, more personal applications, which means it's a business that's not only critical to industries, but also deeply embedded in the global economy. What really makes ITW stand out for dividend investors is its impressive track record of dividend growth. ITW is a dividend aristocrat, meaning it has consistently raised its dividend for over 25 years. This shows the company's solid financial footing and commitment to rewarding its shareholders. With a dividend yield of 2.29%, ITW may not have the highest yield out there, but it's the company's 12.49% compound annual growth rate, or CAGR, over the last decade that is particularly attractive. This growth rate indicates that not only are investors receiving consistent payouts, but they are growing over time, which is a key factor when you're building a long-term passive income strategy. Illinois Tool Works financials are equally impressive. In 2024, the company reported $53.6 in revenue per share, signaling strong, stable growth. Over the past few years, its earnings per share, or EPS, have risen by a staggering 75% from $6.7 in 2020 to $11.8 in 2024. This growth in earnings is a clear sign of strong operational efficiency, and it gives ITW the cash flow to maintain and grow its dividends year after year. The company's free cash flow per share is reported to be $9.6 in 2024, proving that ITW is generating enough cash to comfortably cover its dividend payments without relying on debt or external financing. As for the debt, ITW has managed its liabilities effectively, with $8.1 billion in total debt as of 2024, a manageable number given the company's cash flow and strong earnings. ITW's debt-to-equity ratio of 2.4 is reflective of its cautious approach to leveraging debt, making sure that it maintains financial flexibility while still being able to invest in growth and expansion. In terms of performance, ITW has delivered a 167.15% return over the past decade, slightly trailing the S&P 500's 191.26%, but still offering solid returns over time. When factoring in the dividends and the company's ability to grow them steadily, ITW presents an excellent long-term investment. Looking forward, ITW continues to show promising growth potential. If you and Josh were to invest $60 per week into ITW, your initial investment could grow significantly over time. As for the projection, it has a dividend yield of 2.29%, backed by a strong average 10-year dividend growth rate of 12.49%, and an average 10-year share price appreciation of 7.17%. Based on these metrics after 1 year, the investment would amount to around $3,120. After 10 years, your investment will grow to $51,000, and after 20 years, it will reach $214,000. By the time you hit 30 years, your investment would have appreciated to $964,000. What's even better is that along the way, you'd be receiving passive dividends. After 30 years, your yearly dividends would total $84,000, which translates into $7,000 per month. Before showing the portfolio that matches these returns and is still less risky, let's look at the number 1 stock on my list, which is AbbVie, with a ticker symbol ABBV. AbbVie is a major force in the healthcare industry, known for its highly successful pharmaceutical drugs that have brought in billions of revenue. For years, Humira has been its biggest moneymaker, but the company is already looking ahead. It's investing heavily in new treatments like Skyrizi and Rinvoq, which are showing strong results in treating conditions like rheumatoid arthritis and psoriasis. Even though Humira's patent has expired, AbbVie's focus on innovation puts it in a strong position to keep growing and making big profits. AbbVie isn't just about great products, it's also about rewarding shareholders. The company's dividend yield of 3.34% is attractive, especially given its consistent growth rate of 13.89% annually over the past decade. This kind of dividend growth places AbbVie in a league with the best in the market, as it not only rewards investors but also offers substantial income growth over time. Financially, AbbVie remains very strong. In 2024, it reported revenue per share of $31.8, proving the company is still generating solid income even after Humira's patent loss. While earnings per share, or EPS, dropped from $6.7 in 2022 to $2.4 last year, this is mainly due to heavy reinvestment in research and development. However, this short-term dip doesn't change the fact that AbbVie is still bringing in massive cash flow. With free cash flow per share at $10.1 in 2024, AbbVie can easily cover its dividends and keep rewarding investors. AbbVie has also been working hard to pay down its debt, especially after acquiring Allergan, a move that expanded its product lineup and strengthened its position in the healthcare market. Back in 2020, AbbVie carried a massive $87.1 billion in debt, but by 2024, it successfully reduced that number to $68.3 billion. This shows that the company is serious about managing its finances while still investing in future growth. Even though its debt-to-equity ratio is high at 20.3 in 2024, this isn't necessarily a red flag. AbbVie has used debt strategically, leveraging it to acquire Allergan, expand its research and development, and build a pipeline of new high-potential drugs. This kind of investment is what allows the company to keep innovating, growing its revenue, and rewarding shareholders with rising dividends. The fact that it's steadily paying down debt while still generating strong cash flow proves that AbbVie is balancing growth and financial stability well. When we look at AbbVie's performance, we can see that the company has outperformed the S&P 500 over the past decade, delivering a 226.20% return compared to the S&P 500's 191.26%. This strong performance highlights AbbVie's growth potential, especially as it transitions from the Humira era to a future driven by newer high-growth drugs. While AbbVie's one-year performance of 12.29% is solid, it still trails the S&P 500's 23.49% during the same period, which could indicate that AbbVie is currently undervalued, presenting a potential opportunity for investors. Looking forward, AbbVie's long-term potential remains incredibly promising. As for projection, it has a dividend yield of 3.34%, backed by a strong dividend growth rate of 13.89% and an annual share price appreciation of 11.31%. Now, if you were to invest $60 per week into AbbVie, here's how your investment could grow. After 1 year, your investment will be valued at $3,120. In 10 years, that same investment would grow to $64,000. And after 20 years, it would be worth about $354,000. And by 30 years, your investment would reach a valuation of $1,856,000. That's $1.8 million, all from a consistent $60 per month investment over time. After 30 years, you could expect to receive $110,000 annually in dividends, or $9,200 per month. This is a solid passive income that could fully replace a full-time job for most people. AbbVie is definitely a solid choice, but should you go all in on just one stock? Absolutely not. No matter how strong a company looks, putting all your money into a single stock is a risky move. That's why the best approach is to build a well-balanced portfolio, and these 3 stocks together could be a game changer. For the portfolio, you will have separate investing metrics. To calculate the average current dividend yield across the 3 stocks, add up their yields and divide by 3. For example, we have PLD at 3.18%, ITW at 2.29%, and ABBV at 3.34%. So the calculation is 3.18% plus 2.29% plus 3.34% divided by 3, which gives us an average of 8.81% divided by 3, or approximately 2.94%. You can apply the same method of averaging to calculate the dividend growth and share price appreciation for the portfolio. So, if you combine these stocks, you will have a portfolio with a current dividend yield of 2.94% and a strong average dividend growth rate of 12.55%. It will also have an average share price appreciation of 9.01%. So what does this actually mean for your money? Let's say you stay consistent and invest $60 a week in this portfolio over time. After 10 years, it would reach $57,000. Fast forward 20 years, and we're looking at $269,000. Give it 10 more years, and after 30 years, your portfolio will be valued at $1,246,000, paying $86,000 in annual dividend income, or about $7,000 per month. This portfolio will be less risky than any of the individual stocks and still match the performance of these stocks. Now, this is a good diversified portfolio, but there is an even better option. Next up. In this video, I'm going to show you and Josh exactly how a simple $90 a week investment into SCHD can grow into a passive income stream powerful enough to surpass your full-time job. I will show you how it works and how SCHD takes the guesswork out. And in the end, I will show you and Josh how to turn $90 into a multi-million-dollar portfolio that pays over $12,000 in monthly dividend income. All right. Now that we've got your attention, let's dive into what SCHD actually is. What is SCHD anyway? SCHD stands for the Schwab US Dividend Equity ETF. Quite the mouthful, but don't worry, I'm going to break it down. In simple terms, SCHD is an exchange-traded fund, or ETF, that invests in US companies known for paying consistent dividends. Now, you might be thinking, okay, that sounds great, but what's so special about it? Here's the deal. Unlike a regular stock, an ETF is a collection of many stocks bundled together. With SCHD, this collection is made up of top-tier, financially stable companies that have a proven track record of not just paying dividends, but growing them over time. What does that mean for you? When you invest in SCHD, you're essentially owning pieces of some of the best companies out there. Companies like Coca-Cola, Pfizer, and Cisco. These are companies that make money year after year, and they pay some of that money back to shareholders in the form of dividends. So, in short, SCHD is your ticket to investing in high-quality companies that consistently return value to their shareholders. And with SCHD, you don't have to worry about picking individual stocks or doing a ton of research. Schwab has done the heavy lifting for you, selecting companies that have strong financials and a history of increasing dividends. And for all of this work, they charge only 0.06%. This means on a $100 investment, you would pay only 6 cents. But why do dividends matter? Dividends are one of the easiest ways to passive income and to build a retirement source. And we all love the idea of making money while we sleep, right? Here's how it works. When a company makes a profit, it can choose to either reinvest that money into its own business or share it with its shareholders. If you own a share of the company, like with SCHD, you get a share of those profits in the form of dividends. And it gets even better. You're not just getting a one-time payment. The real magic happens when those dividends are reinvested back into the fund, which buys you more shares of SCHD. This means you start earning dividends on your dividends. The more dividends you reinvest, the more shares you own, and the more money you make in the future. Let's break it down. Imagine you make a one-time investment of $100 into SCHD. At first, it might not seem like much. Maybe you receive just a few cents in dividends. But here's where the magic of compounding dividends starts to take effect. Let's say SCHD has a 3.5% annual dividend yield, meaning it pays roughly $3.50 per year for every $100 invested. If dividends are paid quarterly, that's about 87 cents every 3 months. The key here is reinvesting those dividends. Instead of taking the cash, your brokerage automatically buys more shares of SCHD. Now, because you own slightly more shares than before, the next dividend payout is a little bit bigger. The next quarter, instead of 87 cents, you will receive 89 cents. Then in the following quarter, it would be 91 cents. Not a huge jump at first, but over time, this compounding effect accelerates. After 2 years, assuming a 9.5% average annual return from both dividends and stock appreciation, your initial $100 investment could grow to around $120. More importantly, your dividends are also increasing. Instead of just $3.50 per year, you would now be earning closer to $4.20 annually, simply because your reinvested dividends have purchased additional shares that now generate even more dividends. And because SCHD has a history of increasing its dividend payouts, you're getting paid more year after year. Now that you understand what SCHD is and how it works, let's dive into a critical question. How does SCHD decide which companies to invest in? How SCHD chooses its companies, the secret sauce behind the selection. SCHD doesn't just randomly choose stocks. It's about selecting companies that are proven winners over the long haul. The backbone of this strategy is the Dow Jones U.S. Dividend 100 Index, which sets strict guidelines to filter out companies that don't meet its high standards. The first big requirement? A rock-solid history of dividend payments. SCHD only includes companies that have paid dividends consistently for at least 10 years. This makes sure that every stock in the ETF has proven its ability to generate profits and return value to shareholders, even during economic downturns. A company that has weathered recessions, market crashes, and unpredictable financial conditions while continuing to pay dividends is a company with staying power, and that's exactly the kind of business you want your money invested in. It also focuses on those that grow them. It specifically selects companies that have a strong history of increasing their dividend payouts over time. Why is this crucial? Because a company that consistently raises its dividends is sending a clear signal. We're financially strong, profitable, and confident about the future. This kind of growth is what helps investors generate more passive income each year, making SCHD a great choice for long-term wealth building. Now, paying dividends is great, but SCHD takes it a step further by making sure the companies it invests in are fundamentally strong. It does this by analyzing key financial metrics, including return on equity, or ROE, measures how efficiently a company turns shareholder investments into profits, free cash flow to total debt ratio, ensures that a company has enough cash flow to cover its debts, reducing financial risk, dividend yield, ensures the company is paying out a meaningful amount in dividends relative to its share price. 5-year dividend growth rate tracks how quickly a company has been increasing its dividend payments. These 4 factors are equally weighted in the selection process, ensuring that SCHD is made up of only the most financially stable, high-performing businesses. Another important feature of SCHD is its diversification rules. No single stock can make up more than 4% or 5% of the fund, and no one sector can exceed 25% of the portfolio. This keeps investors from being too exposed to any one company or industry, providing a balanced mix of reliable, dividend-paying stocks. So, who makes the cut? When you look at SCHD's top holdings, you'll find some of the biggest names in business: Coca-Cola, Pfizer, Cisco, AbbVie, and more. These are companies that have consistently delivered profits, rewarded shareholders, and continued to grow their dividends over time. Bottom line, SCHD is designed to take the guesswork out of investing. Instead of spending hours researching individual stocks, you get a hand-picked selection of financially strong, dividend-growing companies that offer both stability and long-term wealth-building potential. It's a simple yet powerful way to put your money to work for you. In the end, I will show you and Josh how to turn $90 into a multi-million-dollar portfolio that pays over $12,000 in monthly dividend income. Why now? Understanding SCHD's current market position. You might be wondering, is now the right time to invest in SCHD? It's a great question, especially when the market is constantly shifting. But the truth is, SCHD's strategy has proven itself time and time again, and the current market conditions make this a perfect time to jump in. One of the best ways to invest without worrying about market timing is through dollar cost averaging, or DCA. Instead of making a one-time lump sum investment, DCA involves investing a fixed amount at regular intervals, such as weekly or monthly. This approach smooths out market volatility, ensuring you buy at both high and low prices, ultimately averaging your cost over time. Let's say you're investing $90 a week into SCHD following the dollar cost averaging strategy. Since SCHD's price fluctuates, some weeks you'll buy at a higher price and other weeks at a lower price. Instead of trying to time the market, DCA ensures you consistently invest, averaging out your purchase price over time. For example, over 5 weeks, SCHD's price might vary. One week it's $28, the next it's $30, then $26, followed by $29, and finally $27. Each week, your $90 investment buys a different amount of shares. When SCHD is at $28, you get 3.21 shares. At $30, you get 3 shares. When the price drops to $26, you buy 3.46 shares. And at $29, you get 3.1 shares. Finally, when SCHD is $27, you purchase 3.33 shares. After 5 weeks, you've invested $450 total, and your total shares purchased amount to 16.1 shares. This gives you an average cost per share of approximately $27.95. Not the highest price you paid, not the lowest, but balanced over time. This strategy protects you from the risk of buying all at a peak price while ensuring you benefit when prices are lower. Over time, as SCHD continues paying dividends, those payouts will be reinvested to buy even more shares, compounding your returns. Now, let's talk about the current economic environment. Interest rates are getting low, and SCHD's dividend yield of 3.58% offers a better return compared to many traditional savings accounts, bonds, or other lower-risk investments. Better than that, it also grows the dividend by 11.04% each year. Even though it is a dividend-focused ETF, it also has a good share price appreciation. In fact, over the past 10 years, it has increased 106% in value, which is an average of about 7.46% compounded annual growth rate. Future projections. Now, based on these metrics, let's take a look at the real potential of consistently investing $90 a week into SCHD and how it can transform your financial future. Let's do the math. $90 a week multiplied by 52 weeks in a year totals $4,680 annually. That's the starting point, the money you're consistently investing to build your wealth. In 5 years, you'll have invested $23,400, and with the power of compounding dividends and share price appreciation, your portfolio worth will be $29,000. In 10 years, with consistent reinvestment, your portfolio will reach $82,000, more than double what you've put in. Fast forward to 20 years, your $90 a week investment would turn into a portfolio worth $378,000. This is where the growth really starts to accelerate. The reinvested dividends continue to buy more shares, which generates even more dividends, and the capital appreciation pushes your portfolio's value up faster. And the 30-year projection is where it gets exciting. By the time you reach 30 years of investing, your portfolio will easily surpass $1 million. Your total investment would be $140,000, but thanks to the growth of your dividends and the value of your shares, your portfolio will be worth around $1,769,000. And after 30 years, you would be receiving $150,000 a year in dividends, which would work out to roughly $12,000 per month. That's more than enough to cover living expenses, and in many cases, it could even replace or exceed a full-time job's income. SCHD is a very solid ETF to invest in, but how does it compare to an S&P 500 ETF like VOO? Both ETFs have made investors wealthy, but they take very different paths to get there. The real question is, which one will leave you with the biggest portfolio in 10, 20, or even 30 years? Next up, I will show you and Josh head-to-head on their past performance, current performance, and what is their strategy for return. I will see who wins the price appreciation round and dividend. In the end, I will show you a side-by-side projection for the long term with a $100,000 one-time investment. Both have the potential to make you a millionaire, but one of them can double the return. But first, let's do some background checks on these ETFs. Starting with the Vanguard S&P 500 ETF, popularly known as VOO. This ETF is built for long-term market growth. It tracks the S&P 500 index, meaning you own a piece of 500 of the most successful businesses in the country, including Apple, Microsoft, Nvidia, and Amazon. What makes VOO stand out is its capital appreciation potential. The companies in this fund are constantly reinvesting profits to expand their businesses, acquire competitors, and develop new technologies. Instead of paying out high dividends, these companies put money back into their own growth, which has historically led to higher returns. Over the long term, the S&P 500 has averaged about 10% annual returns, making VOO a great option for passive investors. Unlike SCHD, which prioritizes dividends as a source of income, VOO focuses on total return through stock price appreciation. While it does pay dividends, the yield is relatively low, and most of its value comes from holding stocks that increase in price over time. This makes VOO a strong choice for investors with a longer time horizon, especially those who are reinvesting gains and don't need immediate income. But what if your focus isn't just growing your portfolio, but also generating consistent cash flow along the way? That's where Schwab US Dividend Equity ETF, or SCHD for short, takes a completely different approach. If you want your investments to pay you as they grow, SCHD is built for exactly that. It's designed to prioritize cash flow. It invests in a carefully selected group of companies that pay consistent and growing dividends, meaning that instead of just watching your portfolio grow, you're actually getting paid along the way. SCHD's strength lies in high-quality dividend stocks. It doesn't just invest in any company that pays dividends. It focuses on financially stable companies with strong balance sheets, high profitability, and a long track record of returning money to shareholders. These companies, like Coca-Cola, AbbVie, and Pfizer, have been paying and increasing dividends for decades, making them reliable even in tough market conditions. The biggest advantage of SCHD is its dividend yield, which is significantly higher than VOO's. But the real magic happens when those dividends are reinvested, compounding over time to accelerate your portfolio's growth. With a high dividend growth rate, SCHD not only provides income today, but ensures that income keeps rising over time. But to truly see their strengths, you and Josh need to look inside and break down what they own. Let's dive in. Holdings breakdown. When it comes to understanding the investment strategy behind both VOO and SCHD, a crucial factor to consider is the sector breakdown and the top holdings of each ETF. These sectors and companies tell you a lot about how these funds will perform in different market conditions and how they align with your financial goals. Let's start with SCHD. The sectors that dominate SCHD's portfolio are financials, healthcare, and consumer defensive. These are all known for their stability and income-generating potential. Financials make up 18.36% of the fund, with major players like BlackRock in the mix. These are strong, dividend-paying companies with a steady cash flow that can weather various economic cycles. Healthcare takes the second largest spot, representing 17.16% of SCHD, which includes companies like AbbVie and Pfizer. Healthcare stocks tend to perform well regardless of the market cycle, making them reliable dividend generators. Finally, consumer defensive, including household names like Coca-Cola, makes up about 14.55% of the portfolio. These companies often provide steady cash flow, making them a solid choice for a dividend-focused ETF like SCHD. The real key to SCHD's success is its focus on high-quality companies that consistently return profits to shareholders. This focus on dividend payers means that you'll likely receive regular payouts as part of your investment. And the more those dividends are reinvested, the faster your money can grow, compounding over time. More on that later, in the end, when I will show you how this ETF will pay over $30,000 in monthly dividend income. Now, let's take a look at VOO. VOO's strategy, as you'd expect from an ETF that tracks the S&P 500, is a bit more growth-oriented. The largest sector in VOO's portfolio is technology, which makes up 33.74% of the fund. If you're investing in VOO, you're essentially betting on the continued success of tech giants like Apple, Microsoft, and Nvidia, all of which dominate the tech sector. The second largest sector is financials at 13.15%. Other sectors like consumer cyclical, healthcare, and industrials round out the rest of the portfolio, but VOO is still very much driven by the performance of its tech holdings. This focus on technology, which has been a strong performer in recent years, means that VOO can experience periods of rapid growth, but it also comes with more volatility. If you're looking for broad exposure to the US stock market with a focus on growth, VOO provides just that. However, unlike SCHD, which offers steady dividend payouts, VOO's dividends are relatively smaller, and the focus is more on capital appreciation through the growth of the underlying tech and large-cap stocks. So what does this mean for you and Josh as an investor? If you're looking for a more stable, income-driven investment, SCHD could be the way to go, as its focus on dividends and more defensive sectors make it less volatile. On the other hand, if you're willing to accept more volatility for higher growth potential, VOO's tech-heavy portfolio could be a great fit. Both funds are diversified in their own right, but their focus areas make them appealing to different types of investors. When it comes to deciding between VOO and SCHD, one of the most important factors to consider is how each ETF has performed over different time periods. Let's take a closer look at how both have fared over the past year, 5 years, and 10 years, which will help you and Josh understand their strengths and weaknesses in various market conditions. Historical performance comparison. Starting with the one-year performance, we see that VOO has significantly outperformed SCHD. VOO posted a price return of 22.34%, while SCHD only returned 9.15%. This performance reflects the broader market rally, driven in part by the explosive growth in technology stocks like Apple and Nvidia, which makes up a large portion of VOO's portfolio. SCHD, being a dividend-focused ETF, didn't see the same level of growth since its holdings tend to be more defensive and value-oriented. While SCHD still offers solid returns, its focus on dividend-paying companies makes it less susceptible to the market's high-growth periods. Now, let's extend the comparison to 5 years. Over this longer period, VOO has returned 80.70%, while SCHD has returned 41.67%. In this case, VOO's tilt towards growth stocks, particularly in the tech sector, has led to much stronger gains. Over the 10-year period, VOO's performance has become even more impressive, with a total return of 189.34% compared to SCHD's 105.09%. In a minute, I'll show you how this growth alone will make you a multi-million-dollar portfolio. The takeaway from this historical performance comparison is that VOO is clearly the winner in terms of overall growth, particularly in the last few years. So, does this mean you should go ahead and invest all your income in VOO? The simple answer to this is no. While VOO may win in the growth category, SCHD also pays dividends, which grow at a faster rate than VOO's. When you combine that with a dividend reinvestment strategy, it helps make up for the lost capital appreciation. Let's see how it works with future projections. Future projections. So let's get to the real question. What would happen if you invested $100,000 in VOO or SCHD today? Starting with VOO, with a 1.2% dividend yield, 6.75% dividend growth, and a much higher 11.27% annual share price appreciation, it prioritizes growth over income generation. After 1 year, a $100,000 investment in VOO would grow to $112,000. Over 10 years, it would rise to $318,000, showing stronger early growth. At the 20-year mark, VOO would reach $977,000. By 30 years, VOO's investment would be worth $2,943,000. However, the annual dividend income at that point would only be $8,000, or about $700 per month. After 30 years, the total value added is $2,843,000, bringing the final portfolio value to $2,943,000. The bulk of these gains, $2,730,000, come from capital appreciation, while dividends contribute just $113,000. On the other hand, SCHD takes a dividend-focused approach. Its combination of a 3.58% dividend yield, 11.04% dividend growth, and an annual share price appreciation of 7.46% make it a strong long-term investment, especially when dividends are reinvested. After just 1 year, a $100,000 investment in SCHD would grow to $111,000. After 10 years, it would more than triple to $302,000. Fast forward to 20 years, and it crosses the $1 million mark, reaching $1,066,000. But the real power of dividends becomes clear at the 30-year mark, where that same investment would explode to $4,691,000. By then, dividends alone would generate $397,000 per year, or a monthly passive income of $33,000. The total value added after 30 years tells an even clearer story. With SCHD, the final portfolio value stands at $4,691,000, meaning the total wealth generated from this investment is $4,591,000. Breaking it down further, capital appreciation contributes $2,200,000, while dividend reinvestment adds an astounding $2,391,000. This means that more than half of SCHD's growth comes from dividends alone, which highlights the sheer power of compounding over time. This shows the fundamental difference in the way these two ETFs build wealth. SCHD's long-term advantage comes from its dividend compounding effect, while VOO's gains are almost entirely reliant on stock price growth. Now, from the graph you can see that there is faster growth later down the line, particularly after the first 100,000 mark. So what exactly makes the 100,000 mark so tough to reach, and what can you do about it? Today, I will show you why hitting this first major milestone feels like such a grind, and, more importantly, how you can get there faster. The psychology of saving the first $100,000. Here's the thing. Saving money isn't just a financial exercise, it's a mental game. For most of us, the journey starts small, and it can feel slow, painfully slow, like watching paint dry. Let's explain using the example of an everyday investor like George, who has been battling that feeling of making no progress. Here's what's going on psychologically. Saving a big amount, like $100,000, can feel overwhelming. When you're just starting, you're working with a small sum, so each step feels like a drop in a huge empty bucket. Think about it. George might start by saving $100 or $200 a month, but when you're aiming for $100,000, that barely seems like a scratch on the surface. But here's something important to keep in mind. The journey is slow at first, until it hits the golden compounding. Now, I know compounding sounds like one of those fancy finance words, but bear with me. It's actually pretty simple. Compounding is just the process of earning money on the money you've already saved. But there's a catch. It works best when you have more money saved up to begin with. Now think about George. He's saved up $1,000 and maybe he's managed to invest it to earn a return. If his investment earns, say, 5% in a year, he's making $50. That's great, but it's not exactly life-changing, right? And here's where the frustration kicks in. $50 on $1,000 feels like pennies when you're trying to reach six figures. But this is where patience comes in, because by reinvesting the earned income over time, that $1,000 turns into $10,000. Now the same 5% would yield $500 in income. With reinvesting that, $10,000 eventually becomes $100,000, and with each step, compounding gets stronger. At the start, you don't see the full benefit yet. Everything is just chipping away slowly, and it's easy to get discouraged. To help our character and you see the big picture, let's look at the graph here to show the difference in growth at the start versus later. This is a line graph where the first part of the line barely slopes upward. That's George's progress with small savings. But as he saves more, the line starts curving up sharply, showing overall compounding over time. This kind of visual helps to see how patience pays off, even if it's not obvious at first. The first part of saving is about persistence. It's about getting over that psychological hurdle of feeling like your progress is too slow. That's completely normal. Everyone is working through the same struggles, and you're not alone if it feels like you're barely moving forward. The important thing is to stick with it, even if the results feel invisible at first. So George keeps at it, knowing that every dollar brings him closer to the tipping point. That's where investing basics and compounding returns comes in. Alright, now let's get to the heart of what makes saving for that first $100,000 feel like slow progress, and how investing can start to change the game. If George's story so far sounds familiar, you're not alone. A lot of people struggle to get past that initial feeling of why isn't this growing faster? And that's exactly where compounding interest and smart investing start to shine. So let's break down compounding interest or returns in a way that's easy to follow and, more importantly, easy to use. Compounding is what happens when the money you invest starts earning its own money. In other words, you're not just earning interest on your initial savings, you're also earning income on the interest. Sounds simple, right? But here's where it gets exponential. Compounding gets exponentially stronger the more you save, and that's why people say the rich get richer. The reality is, with compounding, even a little bit invested regularly over time can grow into something much bigger. Let's look at this plan as an example. Let's say George is saving and investing a bit to hit his first $100,000 faster. He's starting with $1,000 and plans to add $200 every month, just $50 each week. Not huge amounts, but they add up. And he's aiming for a 5% annual return on his investments. Nothing wild or risky, just a steady, reliable return. In year one, he starts with that $1,000 and adds $200 each month, totaling $3,400 by year's end. With a 5% return, he's earned around $170 on top of his contributions, giving him a total of $3,570. It's a nice boost, but still a long way from his goal. By year two, he adds another $2,400 in contributions, bringing his total to around $6,100, and this time, he earns 5% on the higher balance. Now he's at $6,405. It's slow growth, but as he adds more each month, compounding starts to work a little harder. This process might sound gradual, but if George keeps it up, he's setting himself up for major growth. By the 10-year mark, your balance has reached a level where compounding really starts to kick in. He's now earning a few thousand a year just in interest. The compounding is finally working in his favor because he's saved up enough to make a difference. Why the first part feels slow? The reason the first few years feel so slow is that compounding needs some fuel to get going. Think of compounding like a snowball rolling down a hill. When it's small, it doesn't gain much speed or size right away, but as it rolls, it picks up more snow, gets bigger, and moves faster. That's what's happening to George's savings right around the 10-year mark. Let's put this in perspective with another graph so you can visualize the turning point. The line graph here shows George's savings starting with those small contributions and gradually picking up speed. Notice how, at first, the curve barely moves upward. It's that slow stage we've been talking about. But once he hits a certain point, the line starts curving up at a faster rate. This is the snowball effect in action, and it's a great reminder that patience is essential in the early years of saving and investing. The snowball effect and financial momentum. Now we've seen how George's consistent saving and investing starts off slowly, but what happens once he crosses that turning point? This is where the real magic of compounding, often called the snowball effect, begins to take shape. Imagine a snowball rolling down a hill. It starts small, but as it gathers more snow and picks up speed, it grows bigger and faster. That's exactly what's happening with George's savings once he reaches a certain balance. The power of the snowball effect. When George hits that first big goal around the $100,000 mark, everything starts to accelerate. Suddenly, his money isn't just growing because he's adding more each year, it's growing because the money he's already invested is working for him. In the early years, George's contributions made up most of his account growth, but now, the balance is at a level where the returns alone make a significant difference. Let's break this down with some numbers. After 23 years of consistent saving, George reaches his first $100,000. With a 5% return, that's $5,000 added to his balance in a single year, just from compounding. He's not even doing anything extra at this point. That $5,000 comes from the investment gains, not his own contributions, and it's a huge psychological boost. You can finally see his money working for him, and he realizes that this growth will only continue to accelerate. To make this clear, let's pull up a graph here showing George's balance as it grows from $100,000 to $200,000. You'll notice that while it took 23 years to reach the first 100K, the next one only takes 11 additional years, and the time shortens even further with each new $100,000 milestone. This snowball effect adds more to his balance every year, and he's closing in on his next milestone far quicker than he reached the first one. Making smart investment choices. Now you might wonder, what if George decided to invest in something riskier to speed things up? It's a common thought, especially when progress feels slow. But here's the thing, risky investments come with higher highs and lower lows. George could choose to invest in something like individual stocks with the hope of high returns, but if those stocks don't perform, he could actually lose money, setting him back rather than helping him reach his goal. I prefer to play it safe by putting my money into a diversified index fund that tracks the entire market. An index fund is a type of investment that buys a tiny slice of all the big companies on the stock market. So when the market as a whole does well, my investment grows, and when it dips, I'm less affected than if all my money were tied up in just one or two stocks. This steady approach might seem slow, but it helps me reach my goals without the stress of wild ups and downs. With a $10,000 initial investment and $500 monthly contributions, George starts with a higher compounding base. This significantly reduces the time needed to reach each $100,000 milestone, even at a steady 5% return rate. Here's how long it takes to reach each milestone. He would hit his first 100K in approximately 8 years. The combination of monthly contributions and compounding brings him to this milestone faster than saving alone could. Now, compounding accelerates his progress, taking only about 4 more years to double his balance to $200,000. With the momentum of compounding, the third 100K milestone comes within another 3 years, thanks to the increasing returns on his now larger balance. Each next 100K is achieved more quickly within about 2 to 2.5 years for each increment, as compounding does much of the work, turning steady contributions into substantial growth. The line from the graph starts to bend upward around year 10. This is where compounding interest finally gets some real traction and starts pulling George's balance higher. Each year, his savings grow by a larger amount, not because he's adding more, but because compounding is doing the heavy lifting. This is why people say the first 100K is the hardest. It takes time and patience to get there, but once you hit it, you're on a different level. Compounding starts working faster, and every dollar George has saved is working overtime to help him reach that next goal. Why the next 100K is easier. In the beginning, when George had invested $10,000, a 5% return was only $500, not a huge amount. But as he kept investing, his balance grew, and now a six-figure portfolio brings in thousands every year at that same 5% rate. This change makes the next $100,000 easier. Compounding does most of the work for him. He's now at a level where growth is driven by his investments, not just his savings. Importance of consistency. Consistency is your biggest asset here. Even though he's not investing huge sums, he's putting money in every single year, and that steady contribution keeps him moving forward. Each time he adds to his balance, he's giving compounding more fuel, and this consistent approach is something anyone can replicate. You don't need a huge salary or a massive windfall to make progress, you just need a plan and the discipline to stick with it. Hitting that first $100,000 felt like climbing a mountain, but with patience and a plan, you can make it happen. Want to set it and forget it strategy? Next up, I'll show you and Josh the top 5 best Fidelity index funds. I'll also show you how just $5 a day can grow to hundreds of thousands over 10, 20, and 30 years. In the end, I will show you my top index fund with the potential to turn your initial investment and $5 daily contribution into a portfolio worth over $500,000. But first, why choose index funds? Index funds pool money into a range of stocks, providing exposure to the broader market rather than betting on a single company. This helps reduce risk and increases your chances of steady growth without the need for constant monitoring. They spread risk across many companies, giving you a low-stress, long-term investment strategy. It lets you ride the overall market's growth with minimal effort, like sitting on a bus instead of walking through the stock market maze. And Fidelity offers low-fee, reliable index funds perfect for building wealth with ease. It acts as a stage. Index funds build the base, and compound growth steals the show. Compound growth lets your returns grow on both your initial investment and previous returns. For example, invest $10,000 at a 7% annual return. In year 1, it grows to $10,700. By year 2, you earn returns on $10,700, reaching $11,449. This snowball effect accelerates over time. Fidelity index funds are ideal for compounding, offering consistent returns, growth, and reinvestment potential. With patience and regular contributions, they're a powerful tool for long-term wealth building. Coming next are the top 5 Fidelity index funds ranked from good to the best based on the value they deliver to your portfolio. Number 5 on my list is Fidelity Small Cap Index Fund with a ticker symbol FSSNX, a fund that's perfect for those who love the idea of discovering hidden gems, or as I like to call it, the next big thing. This fund focuses on small cap stocks, companies that are just starting to make their mark but have significant growth potential. While small caps can be a little riskier, they also offer the chance to supercharge your returns if you're willing to play the long game. Small cap stocks are known for their volatility, but that's also what makes them exciting. When the market is favorable, these companies can deliver returns that outpace larger, more established firms. FSSNX gives you a way to benefit from this growth without having to pick individual winners. FSSNX is ideal for investors who are comfortable with a bit of risk and are looking to tap into the dynamism of emerging companies. By staying invested and letting compounding do its work, you're setting yourself up to reap the rewards of this high-growth sector. Here's how your index fund would grow with FSSNX. It has a dividend yield of 0.23%, a dividend growth rate of 4.94%, and an average share price appreciation of 5.89%, which is expected, and the small cap would reinvest most of its profits. For instance, if you start with $10,000 and contribute like $5 a day, by year 1, your portfolio grows to $13,000. 10 years in, it would be valued at $51,000. At year 20, it is projected to reach a valuation of $149,000. And after 30 years, a solid $380,000. FSSNX's dividend payouts are smaller compared to coming funds, with annual dividends of $247 by year 30, which is expected from a sector that reinvests almost all of its profit for growth. However, the strength of this fund lies in its ability to capitalize on the explosive growth of small companies. Next, number 4 on my list is Fidelity 500 Index Fund with a ticker symbol FXAIX. If the stock market had a greatest hits album, this fund would be it. Tracking the S&P 500, it gives you access to 500 of the largest and most influential companies in the US. It is a one-stop shop for blue-chip stocks, offering the stability and growth potential that investors crave. What makes FXAIX a must-have is its balance of stability and performance. Blue-chip stocks are known for their stability, and this fund ensures you're investing in companies that lead the market through innovation and strong fundamentals. Whether the market is up or down, the S&P 500 remains a benchmark for long-term growth. This index fund isn't about flashy returns or high risk. It's about consistency and trust. Over time, it delivers the kind of results that build wealth steadily and securely. For anyone looking to build a solid foundation for their portfolio, FXAIX is the ultimate tool. It's ideal for investors who want exposure to the US market's best performers without having to pick individual stocks. Here's the breakdown of your investment in FXAIX. It has a dividend yield of 1.19%, a dividend growth rate of 5.39%, and an average share price appreciation of 11.20%. All work together to deliver impressive returns over time. Starting with $10,000 and contributing $5 daily, your investment grows to $13,000 after just 1 year. By year 10, it will be valued around $54,000. At year 20, it has the potential to reach a valuation of $164,000. And after 30 years, a solid $430,000. By the 30th year, the annual dividend payout from FXAIX will reach $1,700. While it may not deliver the same level of income as better funds on the list, its strength lies in its capital appreciation. Companies like Apple, Microsoft, and Amazon dominate this fund's portfolio, making it a growth engine fueled by some of the most successful businesses on the planet. These are good returns, but after this, all the index funds will have the potential to cross a $500,000 portfolio valuation. In the end, I will show you my top index funds with the potential to turn your investment into over $600,000 and pay over $22,000 in annual dividends. Next up, at number 3, I have the Fidelity MSCI Consumer Staples Index Fund ETF with a ticker symbol FSTA. If you're looking for stability and steady returns, this fund is like the reliable cornerstone of a portfolio. It focuses on consumer staples, the everyday essentials we can't live without, like food, beverages, and household goods. Even during uncertain economic times, this sector's demand stays, making FSTA a dependable choice for long-term investors. The key to this fund's appeal lies in its stability. While it may not have the high-octane growth of emerging markets or small-cap stocks, it provides a sense of security. Think of it as the financial equivalent of a safety net. When markets are turbulent, consumer staples remain steady, ensuring your portfolio weathers the storm. But don't mistake stability for mediocrity. With its combination of dividend income and capital appreciation, FSTA delivers substantial long-term returns. In essence, FSTA is for investors who value reliability and consistent growth. It's the fund you can count on to keep your portfolio grounded while still delivering impressive results over time. To understand its potential, let's look into the future projections. FSTA has a dividend yield of 2.33%, a dividend growth rate of 7.35%, and a share price appreciation of 5.84%. If you start with a $10,000 investment and contribute $5 a day, by the end of year 1, your portfolio will be valued at $12,923. Fast forward to year 10, and it will reach a valuation of $58,712. After 20 years, it will climb to $192,819, and by year 30, your investment has the potential to reach a solid $552,199. By year 30, your portfolio will pay around $7,386 in annual dividends. These consistent payouts can be reinvested to accelerate growth or used as a reliable income stream. Consumer staples are known for their predictable cash flows, and this fund taps into the strength of industry giants like Procter & Gamble, Coca-Cola, and Walmart. Taking the second spot is Fidelity Advisor Emerging Markets Discovery Fund with a ticker symbol FEDIX. This fund opens up the world of high-growth opportunities by investing in emerging markets, economies that are rapidly developing and poised to become tomorrow's global powerhouses. What sets FEDIX apart is its focus on economies like China, India, Brazil, and others that are on the cusp of significant industrial and technological revolutions. These markets often experience higher volatility than developed ones, but they also provide unmatched opportunities for returns. With FEDIX, you're investing in sectors like technology, infrastructure, and consumer goods that are driving the growth of these regions. The key to success with FEDIX lies in patience. Emerging markets can be unpredictable in the short term, but over the long run, they tend to deliver massive rewards. It combines a competitive dividend yield, strong growth potential, and global diversification into one compelling package. If you're ready to take your portfolio international, FEDIX is the way to go. Now, let's break down the numbers to see why FEDIX is such a valuable addition. This long-term growth is fueled by a strong dividend yield of 2.12%, a dividend growth rate of 9.74%, and a share price appreciation of 3.37%. Starting with an initial investment of $10,000 and a daily $5 contribution, your portfolio grows to $13,000 after just 1 year. By year 10, it climbs to $59,000, and after 20 years, you're looking at $202,000. That's when the compounding snowball effect kicks in, and by year 30, your investment has the potential to reach an impressive $632,000. By year 30, your portfolio will pay around $15,000 in annual dividends, which translates to about $1,300 per month. This fund offers the perfect balance of growth and income, making it a reliable way to capture the potential of emerging markets while benefiting from compounding dividends. And finally, at number 1, and topping my list, is the Fidelity MSCI Healthcare Index ETF, with a ticker symbol FHLC, a heavyweight in the world of smart investing. This fund is the backbone of most portfolios, combining stability with growth potential in an industry that's always in demand. No matter what's happening in the economy, people will always need healthcare. That's what makes this fund so compelling. It thrives on essentials and innovation. What makes FHLC stand out is its resilience. The healthcare sector isn't just about treating illnesses, it's driven by innovation, from groundbreaking medical devices to life-saving drugs. This focus on essentials and progress means that even when the economy struggles, FHLC tends to grow steadily, making it a reliable choice for long-term investments. In short, FHLC combines a strong dividend yield, exceptional dividend growth, and reliable share price appreciation to deliver a powerhouse performance. Now, let's talk numbers because FHLC has some serious credentials. Its current dividend yield stands at 1.39%. Backed by a strong dividend growth rate of 12.42%. This means that over time, the dividends you earn don't just stay the same, they grow and they grow fast. Pair that with the fund's 7.37% annual share price appreciation, and you have a recipe for both consistent income and long-term wealth creation. For instance, if you start with $10,000 and contribute $5 a day, by year 1, your portfolio grows to $13,000. 10 years in, it will be valued at $57,000. At year 20, it is projected to reach a valuation of $195,000. And after 30 years, a solid $646,000. Also, by the 30th year, your portfolio generates $22,000 in annual dividends, or about $1,800 every single month. Next up, I will show you how to turn $10,000 into a $1 million portfolio that pays over $8,000 in monthly dividend income. In this video, I'll break down the math, share smart dividend strategies, and show you how reinvesting those payouts can turn a single paycheck into an $8,000 income stream every month. How do dividends work? Dividends are your share of a company's profits, paid out simply because you own a piece of the business. For example, owning shares in a company like Realty Income Corp means you're entitled to a portion of its profits, which it pays back to investors regularly in cash. It's passive income that feels like a bonus for putting your money to work. But how much can dividends actually earn you? To make this tangible, let's look at what happens when you invest $10,000 in dividend-paying stocks. The annual dividend income from a $10,000 investment chart paints a clear picture. At a 2% dividend yield, your investment generates $200 a year, enough to pay for a monthly Netflix subscription or a few coffee shop visits. At 4%, your income doubles to $400 annually, which might fund both your streaming services and your weekly coffee habit. A 6% yield steps things up further, providing $600 a year, enough to cover a utility bill or stash away for a weekend getaway. While these numbers might sound promising, chasing high yields isn't the whole story. There's more to dividends than just the cash flow today. That's where factors like dividend growth and sustainability come into play. For instance, a higher yield often comes with risks, such as slower capital growth or the potential for dividend cuts during tough economic times. Understanding this trade-off is essential to creating a balanced investment strategy. Another critical consideration is sustainability. Not all companies can maintain their dividend payouts forever, so it's vital to assess their payout ratios. A lower payout ratio means the company retains more of its earnings to reinvest for growth, which bodes well for future dividends. Meanwhile, a higher ratio may signal that the company is stretching its resources, leaving less room to weather financial challenges. A good rule of thumb is to go for companies that have a payout ratio of less than 60%. The real advantage of dividends, however, isn't just in receiving regular cash flow. It's in reinvesting those payouts to compound your returns over time. When you reinvest dividends, you use the money to buy more shares, which in turn generate additional dividends. Over time, this creates a snowball effect, exponentially growing your wealth. I will get into more detail on this later on when I show you an actual portfolio of stocks and how much you can earn in dividends. Dividends, when combined with a strategy that balances yield, growth, and reinvestment, turn your portfolio into a powerful tool for building long-term wealth. Choosing the right dividend stocks, ETFs, and REITs. When it comes to turning $10,000 into a consistent income generator, selecting the right stock is key. Not all dividend-paying stocks are created equal, and blindly chasing high yields can lead to disappointing results, or worse, losing money. Instead, you want a mix of stability, growth, and sustainability. Let's break it down. When selecting dividend stocks, prioritize companies with a history of consistent payouts and dividend growth. These are often referred to as dividend aristocrats, firms that have increased their dividends annually for 25 years or more. Look for companies in stable industries such as utilities, healthcare, and consumer staples. Assess key metrics like the dividend yield, payout ratio, and free cash flow to ensure the dividends are sustainable. High yields can be attractive, but may indicate financial stress if unsustainable. Dividend stocks are the bread and butter of many income-focused portfolios. Companies like Procter & Gamble and Home Depot are excellent examples. If managing individual stocks feels overwhelming, dividend-focused ETFs offer a diversified, hands-off approach. The Vanguard High Dividend Yield ETF is a great example, providing a yield of about 3.3%. It focuses on large-cap, high dividend-paying companies, combining a reasonable yield with a solid dividend growth rate of 7%. This ETF has also delivered an average annual return of 10.4% over the past decade, making it a reliable choice for investors who want broad exposure to dividend-paying stocks without the risk of picking individual winners and losers. For investors seeking passive income, REITs are excellent options. They are legally required to distribute at least 90% of their taxable income to shareholders, resulting in attractive dividend yields. Take Simon Property Group, for instance, which offers a dividend yield of about 6%. Knowing the stocks is just part of investing. How much can $10,000 earn you? Here's the big question. How much can you really make in passive income with $10,000 invested in dividend-paying stocks? The answer depends on the dividend yield of your investments. Let's explore what this looks like with three common scenarios: a 2%, a 3%, and a 4% yield. And let's do it with actual stocks. Schwab U.S. Dividend Equity ETF is a reliable fund offering consistent dividend income and long-term growth through diversified U.S. dividend-paying stocks. It begins with a dividend income of $341 on a $10,000 investment, rising steadily to $598 by the fifth year. This increase reflects both its 3% dividend yield and a 10-year CAGR, or compound annual growth rate, of 11.1%, which drives consistent capital appreciation. The higher CAGR ensures a steadily rising principal value, which in turn increases dividend income. Over time, this combination balances income with reliable long-term appreciation. Extra Space Storage Incorporated is a leading self-storage company combining strong income generation with impressive capital appreciation. It starts at $394 in annual dividends on a $10,000 investment, climbing to $796 by year 5. The 4% yield provides higher upfront income compared to Schwab, while its 14.1% CAGR accelerates principal growth. This strong combination leads to both increasing annual dividends and share price growth. Interparfums Incorporated is a global fragrance company emphasizing high growth potential and premium brand development over immediate income. Despite its lower 2% yield, it offers $394 in dividend income initially, rising to $742 by year 5 due to its exceptional 19.6% CAGR. This remarkable growth rate significantly amplifies the principal value, far outpacing the other companies in the long term. The performance comparison of stocks bar chart highlights the differences clearly. Schwab offers a middle ground with balanced income and growth. Extra Space delivers a stronger income stream with excellent growth, while Interparfums emphasizes explosive long-term growth over upfront income. While none of these options will replace your full-time income immediately, that's not the goal. Dividend investing is about building income and wealth over time. By reinvesting dividends, you can make sure to reach a solid retirement income. More on that later. Even though these three target different timeframes for growth, you can actually combine them to create a solid portfolio. Which brings us to the next step. Making a portfolio of these stocks? The key is to find the perfect balance between income, growth, and stability. For this portfolio, I plan to allocate $10,000 equally invested across all three stocks, totaling about $3,333 for each stock. By averaging the key metrics, the portfolio achieves a 3.25% dividend yield, a 14.93% annual dividend growth rate, and a 10.72% share price appreciation. This mix ensures steady income growth while allowing the portfolio's value to grow over time. Now, let's see what it's like to invest in this portfolio with actual projections. Portfolio without drip. You can see from the graph that the data reflects linear growth over time, driven only by capital appreciation. At year 1, the balance is around $11,000. By year 10, the balance reaches $27,000. At year 20, it grows to about $75,000, maintaining a predictable but slower trajectory. Finally, by year 30, the balance reaches to about $210,000. Portfolio with drip. Even though these are good returns, you can actually supercharge your portfolio if you do one thing: reinvest the dividends you earn from the investment. There's no need to invest anything out of pocket. Here's how much of a difference it can make. The year-end new balance with dividend reinvestment plan, or DRIP for short, compounding through reinvested dividends is evident. At year 1, the balance is still around the $11,000 mark, but year 10, it grows to $39,000. At year 20, the balance reaches $180,000, showcasing the compounding effect gaining momentum. Finally, by year 30, it skyrockets to over $1 million, clearly showing the exponential impact of DRIP over time. Comparison of portfolio valuation with and without DRIP. The comparison between balances with and without DRIP highlights the transformative effect of compounding. With DRIP, dividends are reinvested to generate additional returns, leading to exponential growth over time. In comparison, without DRIP, dividends are withdrawn, resulting in steady but limited linear growth. While the difference between the two approaches may seem small in the early years, the gap becomes dramatic over decades. By the 30th year, balances with DRIP exceeded $1.1 million compared to just $212,000 without DRIP, a nearly 5-fold difference. And the effect is not only seen in portfolio growth, it can also be observed in dividend income. Comparison of dividend income with and without DRIP. This graph provides a clear comparison of dividend income over 30 years between reinvesting dividends and taking them as cash. The reinvestment approach generates significantly more dividend income by the 30th year, nearing $100,000, while taking dividends as cash results in a cumulative income of about $20,000. So, the real answer to how much you can earn in dividends from $10,000 is way higher than you might expect. With a reinvestment dividend strategy, you can grow your portfolio to a valuation of over $1 million, generating more than $100,000 in annual dividends. That's over $8,000 in monthly dividend income for your retirement. The reinvestment strategy leverages compounding, where dividends are used to purchase additional shares, which in turn generate even more dividends. Over time, this creates a snowball effect, exponentially increasing income potential. On the other hand, taking dividends as cash leads to consistent but limited income growth, as the initial investment does not expand beyond its original capacity to generate payouts. It all boils down to this. To maximize dividends from $10,000, focus on reinvestment, diversification, and steady growth. Combine blue-chip stocks, growth companies, and REITs while avoiding unsustainably high yields. Use tax-advantaged accounts to accelerate compounding. Over time, this strategy can turn $10,000 into a sustainable income-generating portfolio for your retirement. Did you know? To hit $2,800 a month in dividends, you need to invest around $1.5 million in the S&P 500. Sounds impossible, right? But what if I told you that with just $10 a day, you could achieve the same goal in a fraction of the time? In this video, I'll show you how to reach the $2,800 a month income using just $10 a day, the fastest way possible. I will show a tailor-made portfolio specifically designed for this strategy which will reach that goal 3 times faster than the broader market. In the end, I'll show you a side-by-side comparison of the S&P 500 and the tailored portfolio, explaining why this approach works best for this strategy. Can the S&P 500 help you achieve $2,800 a month in dividends? Dividends are a powerful way to build passive income. They're regular payments from companies to shareholders simply for owning their stock. Unlike other income sources, dividends are predictable and can grow as companies increase their payouts. But here's the thing. While dividends are a proven path to passive income, not all strategies are equally effective. Many people default to the S&P 500 when they think about long-term investing. After all, it's one of the most popular and trusted indices, representing 500 of the largest companies in the US. Historically, it has delivered an average annual return of 8 to 10%, making it a reliable option for steady growth. However, not all of that return comes from dividends. In fact, only 2 to 3% of the S&P 500's annual returns are typically derived from dividends, with the rest coming from share price appreciation. This low yield presents a major challenge for anyone looking to quickly generate meaningful dividend income. To put this into perspective, let's say your goal is to earn $2,800 per month, or $33,600 per year, in dividend income using the S&P 500. With an average dividend yield of 2.5%, you would need a portfolio worth approximately $1.34 million. And honestly, not many of us would need $2,800 per month if we had that amount of money in the first place. Now, let's assume you're starting with no initial investment and contributing $10 a day, or $3,600 a year. Even with consistent contributions, dividend reinvestments, and the S&P 500's historical average growth rates, it would take about 60 years to grow your portfolio to the size needed to generate that $2,800 level of income. 60 years, a lifetime for most of us, is hardly practical for anyone who dreams of achieving financial independence sooner. So what's the alternative? The solution lies in building a carefully selected portfolio of higher-yield, faster-growing dividend stocks. With the right combination of companies, you can significantly shorten the timeline to reach your income goals. The key lies in focusing on a portfolio of higher-yield, faster-growing dividend stocks. By strategically selecting companies with strong growth potential and reliable payouts, you can accelerate your path to $2,800 per month in dividend income. The math of $2,800 a month. Let's break down the numbers behind the $2,800 monthly dividend income goal. At first glance, it might seem like a daunting figure, but understanding the math can help you see how achievable it really is with the right strategy. To begin, $2,800 per month translates to $33,600 per year in dividend income. The amount of money you need to generate this income depends on the dividend yield of your portfolio. Dividend yield is a measure of how much a company pays out in dividends relative to its stock price, expressed as a percentage. For example, a stock with a 4% dividend yield pays $4 annually for every $100 invested. Here's how the math plays out. If your portfolio has an average dividend yield of 3%, you'd need approximately $1.12 million to generate $33,600 annually. At a 4% yield, the required portfolio size drops to $840,000. With a 5% yield, you'd only need $672,000. Clearly, higher yields allow you to reach your income goal with a smaller total investment. But these often come with trade-offs in terms of growth potential or risk. Balancing yield and growth is critical for creating a portfolio that delivers reliable income while still growing in value. Now let's consider the impact of reinvesting dividends. Reinvestment is the process of using your dividends to buy additional shares of stock. This compounding effect accelerates your portfolio's growth over time, especially when paired with consistent contributions. A reinvested dividend doesn't just grow your portfolio, it also increases your future dividend income because you own more shares that pay out dividends. This snowball effect becomes more noticeable with time as your portfolio builds upon itself, multiplying its value year after year. The beauty of dividend investing is that time works in your favor. The longer you stay consistent, the faster your portfolio grows. But to make it work, you need the right dividend stocks. I'll show you how a tailored dividend portfolio can optimize this process, reducing the amount of time and capital needed to reach $2,800 per month. In the end, I will show you how this portfolio will get you the fastest track to $2,800 per month. In fact, it will reach that target in less than 20 years. When it comes to choosing the right dividend stocks, you've got to think strategically. After all, the goal isn't just to earn dividends, but to build a portfolio that can reach the goal fastest. To reach the financial goal of $2,800 a month in passive income, I focus on a few key selection criteria for building my portfolio. First, dividend yield is crucial. While a higher yield means more immediate income, I avoid extreme yields as they can be risky. Companies with unsustainably high dividends might cut payouts if their financial situation deteriorates. I aim for a yield between 2% and 5% to strike a balance between stable income and growth. Next, I consider the dividend growth rate, or CAGR, which tells me how much a company increases its dividend payouts over time. A strong growth rate, ideally around 10%, indicates that the company is committed to rewarding investors. This growth helps compound my income over the long term. The payout ratio is another important factor. A payout ratio under 60% suggests that the company is in a good position to reinvest in its business while still maintaining dividends. High payout ratios can be acceptable if the company is in a stable industry with predictable cash flows, but I'll prioritize companies that leave room for reinvestment and stability. Diversification is key to reducing risk and improving returns. To achieve this, I'll include real estate investment trusts, or REITs, in my portfolio, as they are required by law to distribute at least 90% of their income as dividends. This makes them a great choice for generating passive income. Lastly, I'll prioritize companies that have a strong track record of both dividend growth and price appreciation. This ensures that my portfolio not only generates consistent income, but also appreciates in value over time. Now that I have covered how I choose the right dividend stocks, it's time to construct a portfolio specifically tailored to help you achieve $2,800 per month in dividends. The goal is to create a balanced mix of high yield, high growth, and stable dividend stocks that will steadily compound over time. This portfolio is carefully designed with 5 selected stocks, each playing a unique role in delivering consistent income and robust growth. At its core, the portfolio includes Rexford Industrial Realty Incorporated, or REXR, a dependable real estate investment trust with a 4.17% yield and a solid dividend growth rate of 11.10%. Specializing in industrial properties, Rexford benefits from the rising demand for logistics and warehouse spaces, offering reliable and predictable cash flows. Alongside Rexford, another key player is CubeSmart, or Cube. This REIT focuses on self-storage solutions, combining a high yield of 4.3% with an impressive dividend growth rate of 14.65%. Adding global exposure is American Tower Group, or AMT, which stands out with a yield of 3.13% and a remarkable 17.48% dividend growth rate. American Tower focuses on telecom infrastructure, a rapidly expanding sector fueled by the global demand for connectivity. Its steady price appreciation and rapid dividend increases make it a compounding powerhouse, driving significant value over time. For added stability, the portfolio includes Kroger Company. As a dominant player in the grocery sector, Kroger offers a stable yield of 2.16% and a 13.63% dividend growth rate. Its position in consumer staples ensures predictable revenue and dependable payouts, even during economic downturns. Kroger balances the portfolio by providing steady income with moderate growth. Finally, there's Lennar Core Class A, or LIN, which focuses on explosive long-term appreciation. While its yield is modest at 1.22%, Lennar's exceptional dividend growth rate of 26.11% and average annual price growth of 13.83% make it a vital driver of portfolio growth. Its ability to rapidly expand both its share price and payouts positions it as a critical component of this strategy. When combined, these stocks offer an average dividend yield of 3%, a dividend growth rate of 16.59%, and an annual share price appreciation of 8.9%. This balance ensures that the portfolio not only generates consistent income, but also grows in value, compounding your contributions and reinvestments over time. Let's take a closer look at how this portfolio grows. In the first year, your $10 a day contribution will total about $3,600 by the end of the year. By year 5, the portfolio grows to about $23,000. Fast forward to year 10, and the portfolio expands to $68,000, generating $3,300 annually, or about $275 per month. By year 15, the portfolio's value reaches $170,000, with annual dividends at $12,000, equating to about $1,000 per month. The real breakthrough comes in year 19 when the portfolio hits $360,000 and annual dividends grow to $34,000, hitting the $2,800 a month target. The key takeaway is clear. This portfolio is built to maximize income while minimizing risk. By focusing on reinvestment, strategic stock selection, and consistent contributions, you can achieve $2,800 a month in dividends within 19 years. Beyond that, the income continues to grow, providing a comfortable margin for long-term financial freedom. Now take a closer look at how it compares to traditional strategies like investing in the S&P 500 and why this method can get you to $2,800 per month much faster. Realistic timeline to hit $2,800 a month. Achieving your income goals through dividend investing is all about strategy and timing. Our portfolio accelerates reaching $2,800 a month in dividends, outperforming traditional methods like the S&P 500. While the S&P 500 offers steady 8 to 10% returns with a 2.5% dividend yield, requiring a $1.34 million portfolio and 60 years with $10 daily contributions to generate $33,600 annually, our customized approach makes a significant difference. With a 3% yield, 16.59% dividend growth, and 8.9% annual appreciation, you can reach $2,800 a month in just 19 years. This dramatic reduction in time is due to a combination of higher initial yields, rapid dividend growth from stocks like American Tower Corp and Lennar Corp, and consistent reinvestment. These factors create a compounding effect that accelerates growth exponentially over time. Compared to the S&P 500, this strategy achieves financial independence 3 times faster.
What if you could hit the $3,000 milestone each month without working a second job or spending extra hours hustling? Well, it's possible, and you don't need hundreds of thousands to invest. In this video, I'll show you the top 5 monthly dividend stocks that can pay you $3,000 in rent money with just a weekly $90 investment. And in the end, I'll show you and Josh a monthly dividend stock that can help you reach this goal in as little as 14 years. Why monthly dividend stocks are a game changer. But first, why are monthly dividend stocks such a big deal? Most stocks make you wait 3 months for dividends, but with monthly payouts, you get a steady cash flow that's perfect for tackling rent or bills. Even better, reinvesting those earnings turbocharges your growth. Think of it like a snowball rolling downhill. And let's be honest, there's something deeply satisfying about seeing that money hit your account every month. It's proof that you're in control, building financial security one step at a time. Coming up, I'll share the top 5 monthly dividend stocks ranked by how quickly they can help you and Josh reach $3,000 per month in passive income to cover your rent. At number 5, I have Sabine Royalty Trust with ticker symbol SBR. It stands out as a unique dividend-paying stock, offering steady income directly tied to royalties from oil and gas production. This makes it an attractive option for investors looking to diversify into the energy sector while enjoying the benefits of a high-yield dividend payer. The benefit of SBR lies in its business model. Unlike companies that drill or manage operations, SBR simply owns royalty interests in oil and gas properties. Every time oil or natural gas is extracted and sold from these properties, SBR earns a portion of the revenue, which it then distributes to shareholders. With a 6.03% dividend yield, a 4.16% growth rate, and an annual share price appreciation of 4.5%, it's an income-generating machine for patient investors. Let's look at the numbers. Starting with a weekly contribution of $90 and reinvesting dividends, the compounding growth begins to take effect. After the first year, the portfolio stands at $4,320. By year 10, the investment grows to $70,200, generating an annual dividend income of $3,400. By year 20, the portfolio value rises to $255,650, providing $13,000 annually, roughly $1,000 monthly in dividends. By year 30, the investment reaches $734,850, with dividends climbing to $36,300 annually, or $3,000 per month. A key milestone is achieved in year 30 when monthly dividends cross the $3,000 threshold. Next, at number 4, I have Main Street Capital Corp., or MAIN for short, which is a high-yield star in the world of dividend investing, offering both substantial income and long-term growth. As a business development company, or BDC, Maine plays a unique role by lending to and investing in small to mid-sized businesses, the type of companies that fuel economic growth. Its focus on smaller businesses means it's more exposed to economic fluctuations than companies with more established client bases. A recession or credit crunch could impact its portfolio and, consequently, its dividends. However, Maine has a proven track record of maintaining steady payouts, even during challenging times, thanks to its strong management and diversified portfolio. Maine offers an attractive 7.64% dividend yield, making it a top choice for those seeking high-income investments. But it doesn't stop there. With an annual growth rate of 3.85% and annual share price appreciation of 5%, Maine provides a dual benefit: regular reliable income and portfolio growth over time. Now let's look into the numbers. Starting with a weekly contribution of $90 and reinvesting dividends, the compounding magic takes hold. By year 10, your investment grows to $76,300, providing an annual dividend income of $4,500. By year 20, the portfolio reaches $299,200, and the annual dividend income climbs to $16,250, enough to provide $1,350 per month. Finally, by year 28, the portfolio value hits an impressive $731,500, and the dividend income soars to $36,000 annually, hitting the $3,000 monthly dividend target. Third on my list is Wisdom Tree US High Dividend Fund with the ticker symbol DHS, which is a well-rounded option for investors who prioritize diversification and consistent income growth. As an exchange-traded fund, or ETF, DHS offers exposure to a broad range of high dividend-paying U.S. companies, reducing the risk associated with investing in individual stocks. Its combination of stability, diversification, and compounding potential makes it a strong candidate for anyone seeking financial independence through dividend investing. DHS focuses on companies with robust dividend histories and sustainable payout strategies, ensuring a reliable and growing income stream for investors. With a 3.79% dividend yield, an impressive 7.06 annual dividend growth rate, and an annual share price appreciation of 3.2%, this ETF balances current income with long-term compounding. As for the projections, starting with a weekly contribution of $90 and a reinvestment of dividends, the compounding effect is evident from the start. After the first year, the portfolio value is $4,320. By year 10, the investment grows to $62,500, generating $2,860 annually in dividend income. At year 20, the portfolio reaches $229,000, producing $15,700 annually in dividends. By year 25, the portfolio value rises to an impressive $429,800, with annual dividends reaching $35,500, or roughly $3,000 per month. Sounds good, but there are even better options. In the end, I'll show you and Josh a monthly dividend stock that can help you reach this goal in as little as 14 years. Next, number 2 on my list is Realty Income Corp, famously known as the Monthly Dividend Company, stands as one of the most stable and reliable in dividend investing. With a track record of delivering consistent monthly payouts for decades, it has earned the trust of income-focused investors. Realty Income's business model revolves around its vast portfolio of over 12,000 properties, leased to dependable tenants like Walgreens and Dollar General. While Realty Income is tied to the real estate market and can be impacted by economic downturns or rising interest rates, its focus on long-term leases with financially stable tenants helps mitigate these risks. This makes it a resilient option for investors who value consistent, growing income. Offering a 6% dividend yield, a 3.95% annual dividend growth rate, and an annual share price appreciation of 0.89%. Realty Income combines immediate income with powerful compounding potential. For a weekly investment of $90 and reinvestment of dividends, the power of compounding builds wealth steadily. After just 1 year, the portfolio value stands at $4,320, laying a solid foundation for future growth. By year 10, the portfolio grows to $63,000, generating an annual dividend income of $4,200. By year 20, the portfolio reaches $237,500, providing $22,250 annually. The target of $3,000 in monthly dividends is achieved by year 23, and at that time, the valuation stands at $350,000. And now, finally, taking the top spot on my list is the First Trust Buy Right Income ETF, or FTHI, which is a unique powerhouse in the dividend investing world. It combines a portfolio of dividend-paying stocks with a covered call strategy, generating a high-yield income stream for investors. It holds stocks, the covered part, and sells call options, giving others the chance to buy those stocks at a set price. In return, the ETF earns a fee, the premium. If the stock doesn't exceed the set price, the ETF keeps both the stock and the premium. This strategy generates regular income from dividends and premiums, making it ideal for investors focused on steady cash flow rather than big capital gains. However, as with any investment, there are risks. FTHI's reliance on covered call strategies means it sacrifices some capital appreciation for immediate income. Additionally, market volatility can affect the value of its underlying assets. That said, its premium collection strategy offers a buffer, mitigating some downside risks. This strategy boosts income by collecting option premiums, which are distributed to shareholders along with dividends. With a staggering 8.63% dividend yield, a 9.43% dividend growth rate, and an annual share price appreciation of 2.1%, FTHI is designed to maximize cash flow. Let's look at the numbers. Starting with a weekly contribution of $4,320 and reinvesting dividends, the power of compounding delivers extraordinary results. After the first year, the portfolio value is $4,320. By year 10, the investment grows to $90,000, generating an annual dividend income of $11,750. In just 4 more years, by year 14, it reaches a valuation of $220,500 while paying an annual dividend of almost $38,000, which equates to a monthly dividend income of roughly $3,150. Now, let's combine all these stocks on a horizontal timeline. Combination of all stocks. The horizontal timeline provides a clear visualization of the milestone years for each stock achieving its target dividend income, starting from the longest to the shortest. SBR takes the longest, reaching its milestone in year 30. Main follows, achieving its target in year 28. DHS reaches the milestone in year 25, driven by a diversified portfolio of high dividend-paying stocks. Realty Income Corp., known as the monthly dividend company, achieves its target in year 23. Finally, FTHI reached its goal fastest in year 14, leveraging its high-yield covered call strategy. What's your financial goal for 2025? Is it building wealth, creating a steady income stream, or securing a comfortable retirement? Why not all? In this video, I'm sharing my top 5 dividend stocks that offer both growth and income potential. I'll break down how much you can earn from each of these stocks with a one-time investment of $10,000. You'll see stocks that can pay over $15,000 annually in dividends, and in the end, I'll show you and Josh a stock that can turn a $10,000 investment into a valuation of over $2 million while paying more than $60,000 in annual dividends. But first, how did I select these stocks? Selecting the best dividend stocks requires a careful balance of income, growth, and financial stability. The stocks I've selected have been chosen for their proven ability to deliver value to investors even when the markets get unpredictable. A strong dividend yield is the bedrock of any great income stock, offering reliable cash flow you can count on. But let's be honest, yield alone isn't enough. What really matters is consistent dividend growth. When companies steadily increase their payouts, it's like they're saying, we're financially strong, committed to our shareholders, and capable of growing profits year after year. To make sure these stocks are built to last, I look into their financials, looking at key metrics like free cash flow, net income, and operating income. These numbers tell the real story, whether a company can keep paying and growing dividends even during tough economic times. I also look at their market position. Industry leaders with a clear edge tend to stay strong no matter how bumpy the road gets, making them excellent long-term bets. Finally, I considered their history and future potential. A strong track record shows stability, while a solid growth strategy tells me they're in it for the long haul. Put all these pieces together, and you've got a lineup of stocks that are not just reliable, they're designed to help you achieve financial freedom. Based on these criteria, let's look into the 5th pick on the list. CubeSmart with a ticker symbol CUBE. CubeSmart is a top player in the U.S. self-storage market, offering reliable and flexible solutions for both residential and commercial customers. What makes CubeSmart stand out is its resilience. Whether the economy is booming or facing challenges, the demand for self-storage stays strong. By focusing on high-demand urban areas, CubeSmart ensures a steady stream of income and strong occupancy rates, making it a favorite for income-focused investors. In 2024, CubeSmart showcased its strength and solid financial results that highlight its efficiency and growth. The company brought in approximately $1,006.9 million in revenue. This came from strong rental income and a laser focus on keeping occupancy rates high. While net income dipped slightly to $402 million from $410.8 million, CubeSmart continued to show its ability to generate reliable returns for shareholders, with earnings per share, or EPS, of $1.78 compared to $1.82 previously. One key highlight is CubeSmart's funds from operations, or FFO, a critical measure for REITs. It rose nearly 6% year over year to $2.68 per share, showing the company's ability to generate steady cash flow to support dividends and fund reinvestments. With strong free cash flow, CubeSmart has been able to expand its portfolio in high-demand markets like New York and New Jersey, where barriers to entry are high, but opportunities are even greater. It has a current dividend yield of 4.88%, an annual share price appreciation of 4.5%, and a dividend growth rate of 9.77%. Starting with a $10,000 investment, CubeSmart's projections over 30 years are impressive. In the first year, the portfolio grows to $11,000. By year 10, it reaches $28,000, nearly tripling the initial amount. At the 20-year mark, the portfolio surges to $111,000. Finally, after 30 years, the portfolio climbs to $798,000, paying an annual dividend income of $137,000, or $11,400 per month. The total value added over 3 decades stands at $788,000, with $164,000 from capital appreciation and $624,000 from reinvested dividends. Next on the list is Hormel Foods Corporation, a trusted name in the consumer staples sector that has consistently delivered value to its shareholders for over 5 decades. With iconic brands such as Spam, Skippy, and Jennie-O, Hormel benefits from steady demand, making it a reliable player in both favorable and challenging economic conditions. Its diversified portfolio and broad customer base ensure consistent revenue streams, while its focus on innovation and operational efficiency keeps it competitive in a crowded market. This year, the company reported net sales of approximately $12 billion, with operating income of $1.1 billion, which shows its ability to manage costs effectively. Hormel also generated $12 billion in cash flow from operations, reinforcing its financial stability and ability to fund dividends. Earnings per share for the year stood at $1.47, reflecting consistent profitability despite rising input costs and shifting consumer preferences. Hormel's strategic investments in its product portfolio have allowed it to adapt to changing market conditions while retaining its focus on long-term growth. With a current dividend yield of 3.64%, Hormel is a reliable income generator. The company has increased its dividends for 59 consecutive years, with a compound annual growth rate of 10.94% in payouts. Additionally, its annual share price appreciation of 3.2% underscores its steady, if not rapid, growth. Starting with a $10,000 investment, after the first year, the portfolio grows to $11,000. By year 10, the investment more than doubles to $22,000. At the 20-year mark, it rises to $84,000, and after 30 years, the portfolio reaches an impressive $865,000. At this point, annual dividends amount to $203,000, or roughly $16,900 per month. The total value added over 3 decades amounts to $855,000, with $103,000 stemming from capital appreciation and $753,000 from reinvested dividends. These are very good returns, but there are even better options up next. In the end, I'll show you and Josh a stock that can turn a $10,000 investment into a valuation of over $2 million while paying more than $60,000 in annual dividends. Third on the list is AbbVie, a global leader in biopharmaceuticals and a powerhouse in healthcare innovation. Known for blockbuster drugs like Humira, Imbruvica, and Rinvoq, AbbVie's diverse portfolio spans immunology, oncology, neuroscience, and aesthetics, positioning it as a top choice for long-term growth and stable income. Despite growing competition for Humira, AbbVie's commitment to innovation and new product development has kept its revenue on an upward trajectory. Its focus on reducing debt and reinvesting in its pipeline ensures it remains competitive in the fast-changing pharmaceutical landscape. In 2024, AbbVie reported total revenue of approximately $55.5 billion, driven by a robust portfolio and successful product launches. Operating income stood at $17.3 billion, showcasing strong profitability and efficient cost management. AbbVie also generated significant free cash flow, supporting research and development, debt reduction, and an attractive dividend policy, with a net income of $5.1 billion and an EPS of $2.82. AbbVie has a current dividend yield of 3.69%, supported by a stellar dividend compound annual growth rate of 14.08%. The stock also has an annual share price appreciation of 10.38%, making it a robust choice for both income and capital growth. Starting with a $10,000 investment, after the first year, the portfolio grows to $11,000. By year 10, the investment reaches $40,000. At the 20-year mark, the portfolio grows to $185,000. That's when the compounding effect takes charge. After 30 years, the investment soars to an impressive $1,089,000, generating annual dividends of $95,000, or approximately $7,900 per month. Over the 3 decades, the total value added amounts to $1,079,000, with $582,000 from capital appreciation and $497,000 from reinvested dividends. Second last on my list is Extra Space Storage. Like Cube, it is also a dominant player in the self-storage industry, renowned for its expansive network and strategic growth initiatives. The company made headlines last year with its $11.6 billion merger with Life Storage, positioning itself as the largest self-storage operator in the United States. This merger expanded its footprint to over 3,700 locations and a customer base of more than 2 million. The scale of this operation, combined with the company's strategic market positioning, makes Extra Space Storage a robust contender for long-term growth and reliable income. The company's financial performance has been strong. In 2024, Extra Space Storage reported same-store revenue of $3.3 billion and same-store net operating income of $1.5 billion, proving its ability to sustain profitability even during a period of significant expansion. The merger with Life Storage is expected to generate $100 million in annual synergies, further boosting operational efficiency. Extra Space Storage also maintains healthy earnings per share of $3.81, enabling consistent dividend payouts and reinvestments into its growth strategy. Extra Space Storage offers a current dividend yield of 4.38%, with a remarkable compound annual growth rate of 13.6% for dividends. Additionally, the stock boasts an annual share price appreciation rate of around 10%, making it an excellent choice for investors seeking a mix of income and capital growth. Starting with an initial $10,000 investment, the projections over 30 years highlight its wealth-building potential. After the first year, the portfolio grows to approximately $11,000. By the 10-year mark, it reaches $41,000. At 20 years, the portfolio value grows to $203,000. And by 30 years, it has the potential to reach an impressive $1,308,000. At this point, the investment generates an annual dividend income of $131,000, or approximately $10,900 per month. Over 3 decades, the total value added is $1,298,000, with $638,000 derived from capital appreciation and $660,000 from reinvested dividends. And now, finally topping my list at number 1 is NetEase, a Chinese technology and gaming powerhouse. It has established itself as a global leader in online entertainment and digital innovation. The company's portfolio includes online gaming, education technology, music streaming, and e-commerce, giving it a diversified revenue stream and a competitive edge in the fast-evolving tech sector. Known for its flagship games like Fantasy Westward Journey and Justice Online, NetEase has consistently delivered high-quality content that appeals to a broad audience. NetEase has demonstrated impressive financial resilience and growth. In 2024, the company reported total revenue of approximately $15 billion, representing strong year-over-year growth fueled by its gaming and music streaming divisions. Operating income reached $4 billion, showcasing its efficiency in managing costs while driving profitability. One of NetEase's significant strengths is its ability to leverage its home market of China while expanding internationally. Its focus on developing high-quality games and licensing agreements with global developers has diversified its audience base, reducing reliance on any single region or product line. The company's ability to innovate and expand into global markets has solidified its position as a leader in the tech and gaming sectors. Additionally, its focus on high-margin businesses like online gaming ensures consistent profitability even in volatile market conditions. NetEase's current dividend yield is 2.67%, complemented by an exceptional dividend compound annual growth rate of 17.29%. The stock also boasts an impressive annual share price appreciation rate of 16.26%, making it a strong candidate for investors seeking a blend of income and high-growth potential. Here's how a $10,000 investment is projected to look in the future. After the first year, the portfolio will grow to approximately $12,000. By the 10-year mark, the investment reaches $57,000, thanks to high capital appreciation. At 20 years, the portfolio value rises to $336,000, and by the 30-year mark, it reaches a staggering $2,027,000. At this point, the portfolio generates an annual dividend income of $61,000, or roughly $5,100 per month. Over 3 decades, the total value added is $2,017,000, with $1,666,000 from capital appreciation and $351,000 from reinvested dividends. Where do I start? How long will it take to reach my goals? Can I build a 6- or 7-figure portfolio with just $50 or $150 a week? What's the best strategy to get there? If you're asking yourself these questions, this video is for you. In this video, I'm busting the myths about the huge upfront investment needed. I will show you and Josh how anyone can build a wealth through smart dividend strategies. No excuses, no shortcuts, just results. I will share a tailored portfolio for this strategy, and in the end, I'll show you whether you can reach $1 million valuation with only $50 or $150 weekly investments. Setting the stage, the problem and solution. Most people think about dividend investing. They imagine needing huge sums of money to make it worthwhile, and they're not wrong, on the surface. Sure, the idea of living off dividends sounds great, but when you hear stories of people earning thousands in passive income, you realize they're sitting on $1 million portfolios. For most of us, that feels way out of reach, right? But for that, I have the creative visualization that underscores how strategic approaches simplify dividend investing and make financial goals achievable. The bar chart shows the transition from problems to solutions in dividend investing across 3 key factors: initial capital, patience, and consistency. Red represents the difficulty level, while green highlights how the proposed solution mitigates these challenges. For instance, the significant initial capital challenge is reduced through smaller, consistent contributions like $50 or $150 weekly. Similarly, the patience required becomes manageable as the solution emphasizes long-term growth. Consistency, once seen as difficult, turns into a strength as the solution capitalizes on reinvestment and compounding. It can feel overwhelming to start from scratch. If you're like Josh and most beginners, the biggest hurdle is believing that small, consistent investments can make a difference. After all, what can $50 a week really do when dividend yields are only a few percentage points? Add to that the temptation to chase high-yield stocks or the impatience that comes with waiting for results, and it's no wonder people get discouraged. The key here is compounding. By investing a manageable amount every week and reinvesting your dividends, you're leveraging the power of compounding. It's like a snowball rolling downhill. It starts small but grows larger and faster over time. And with the right stock picks, you're not just looking at capital appreciation, you will watch your dividend income grow year after year. Let's simplify the concept of compounding with a one-time investment example. Let's say Josh invests $100 today and it earns an average annual return of 8%, a mix of dividend income and capital appreciation. With compounding, your investment grows not only based on the initial $100, but also on the returns it generates each year. At the end of the first year, your $100 grows by 8%, adding $8, for a total of $108. In the second year, your returns are calculated on the $108 rather than just the original $100. This means you earn $8.64 in year 2, 8% of $108, bringing your total to $116.64. Without compounding, the growth would remain constant at $8 per year, resulting in $116 after 2 years. However, with compounding, you've earned an extra 64 cents. Not much in 2 years, but over decades, this effect becomes exponential. For example, after 30 years, that same $100 would grow to $1,006, thanks solely to compounding at 8%. This simple example highlights how reinvested returns accelerate growth, making compounding the most powerful tool in building long-term wealth. In the end, I'll show you whether you can reach $1 million valuation with only $50 or a $150 weekly investment. Selection criteria for the dividend portfolio. Now that we've talked about the power of starting small, let's dive into the criteria I use to select dividend stocks. Because let's be honest, not all dividend stocks are created equal. Choosing the right ones is what makes this strategy work. First up is dividend yield. This tells you how much you'll earn in dividends relative to the stock price. A higher yield might seem tempting, but here's the catch. Super high yields can sometimes signal a company is in trouble. Instead, I aim for stocks with sustainable yields, typically in the 2 to 5% range, because they strike the perfect balance between current income and growth potential. Next is the dividend growth rate. It's not just about how much a company pays now, it's about how much they'll pay in the future. Companies like Hormel or PepsiCo, for example, have consistently increased their dividends over the years. This means your income grows without you lifting a finger. I love looking at the 10-year compound annual growth rate, or CAGR, for dividends to spot winners. A good range for me is between 5 to 15%. Then there's the payout ratio. This measures how much of a company's earnings go toward paying dividends. A healthy payout ratio, usually under 60%, means the company has room to grow those dividends while reinvesting in its business. Also, diversify across sectors and focus on companies with strong fundamentals for steady, reliable, long-term returns. With these criteria in mind, you'll be set up for a portfolio that doesn't just look good on paper, it delivers real, sustainable results. Next up, let's break down the weekly portfolios of $50 and $150 and see how these criteria come to life. And in the end, I'll show you whether you can reach $1 million valuation with only $50 or $150 weekly investments. The portfolio. I am aiming to create a portfolio that balances stability, growth, and consistent income. The focus is on carefully selected stocks that not only pay reliable dividends, but also compound significantly over time, turning small steps into massive financial progress. This portfolio is built with 5 stocks, each serving a strategic purpose in creating a blend of security and growth. At the heart of this portfolio is Vanguard's S&P 500 ETF, or VOO, a rock-solid investment that gives you exposure to the biggest and best companies in the market. With a dividend yield of 1.24% and a steady growth rate of 7.19%, VOO acts as the anchor of your portfolio. On top of that, its annual share price appreciation of around 10% means you're not just earning dividends, you're also seeing your investment grow over time. Next, I have Hormel Foods, or HRL, a household name known for its dependable products and even more dependable dividends. With a yield of 3.67% and a fantastic 10.94% dividend growth rate, Hormel has proven itself as a reliable income generator even during tough economic times. Then there's Target, or TGT, a retail giant that brings both growth and income to the table. Its dividend yield of 3.43%, paired with an 8.86% dividend growth rate, makes it an excellent choice for balancing risk and reward. For a growth boost, I have included CubeSmart, or Cube, a high-yielding real estate investment trust, REIT, specializing in self-storage solutions. This one's exciting because of its 4.98% dividend yield and a solid 14.65% dividend growth rate. With rising demand for self-storage, CubeSmart is positioned for strong returns and brings valuable diversity to your portfolio. Finally, there's PepsiCo, or PEP, the dividend aristocrat that needs no introduction. With a yield of 3.58% and a dividend growth rate of 7.73%, PepsiCo is a powerhouse of both income and growth. Each stock in this portfolio plays a unique and essential role. Vanguard's S&P 500 ETF anchors the portfolio with stability and steady growth, while Hormel Foods offers reliable dividends and resilience during tough times. Target balances growth and income
benefiting from strong consumer spending trends. For accelerated growth, CubeSmart provides high dividend yields and exposure to the booming self-storage sector. Finally, PepsiCo, a global powerhouse, delivers consistent payouts and long-term appreciation. Together, these investments create a blend of security, growth, and income designed to compound wealth over time. This portfolio delivers a 3.38% dividend yield for steady income, a strong 9.87% dividend growth rate to compound returns, and a 5.2% average share price appreciation for long-term growth. The beauty of this portfolio lies in how it grows over time. Here's what happens if you invest $50 weekly into this portfolio. $50 future projections. In the first year, your $50 weekly contributions total $2,600, setting the stage for compounding growth. After 10 years, the portfolio expands to $40,834, generating dividends that are automatically reinvested to accelerate its momentum. By year 20, the portfolio reaches $170,923, providing an annual dividend income of $5,774. Fast forward to 30 years, and you're looking at a portfolio valued at $786,809, paying an annual dividend income of $84,550, or $7,046 per month. Even without an initial lump sum investment, this portfolio shows how small, disciplined actions can lead to significant wealth accumulation. Next, let's see what happens when we scale this strategy up to $150 weekly contributions. The $150 weekly portfolio. While the $50 weekly portfolio is an excellent starting point for building wealth over time, increasing your contributions to $150 a week takes your investment journey to an entirely new level. With more money to invest, you can not only accelerate the compounding process, but also design a portfolio that leans more heavily into growth while still maintaining stability and consistent income. Here's what happens if you invest $150 per week into this portfolio. By the end of the first year, you will have contributed $7,800, which immediately gives this portfolio more room to grow. After 10 years, the portfolio expands to $122,503, 3 times the value of the $50 portfolio at this stage. By year 20, it grows to $512,769, and by year 30, it hits an incredible $2,360,428. The dividend income follows suit, with annual payouts reaching $253,650 by year 30, over $21,000 per month in passive income. What makes this portfolio different from the $50 portfolio isn't the scale of contributions, but also the allocation strategy. With $150 a week, you can allocate more to growth-driven stocks like CubeSmart and Target, which have higher dividend growth rates and long-term capital appreciation potential. The combined graph for $50 and $150 weekly contribution portfolios showcases the transformative power of consistent investing and compounding over time. Both portfolios begin modestly, but as the years progress, their growth accelerates, highlighting how time and reinvestment work together to create substantial wealth. The $50 portfolio, with steady weekly contributions, grows to $786,809 in 30 years, while the $150 portfolio achieves an impressive $2,360,428 in the same time frame. The difference between the two portfolios becomes especially noticeable after the 10-year mark. While they track closely in the early years, the $150 portfolio diverges significantly as reinvested dividends and higher contributions amplify its growth. This widening gap underscores the exponential nature of compounding. The more you invest, the faster your portfolio grows, especially over longer periods. By year 30, the $150 portfolio generated over $21,000 in monthly dividends compared to $7,049 from the $50 portfolio. Whether you begin with $50 or scale to $150, the key is consistency, reinvestment, and allowing time to maximize the rewards of your investment strategy. Both paths lead to financial freedom, but scaling can help you get there faster. It's easy to get caught up in the idea that you need a huge salary or investment to make a real impact on your finances, but that's not the case. Passive income, specifically through dividends, is all about making small, smart moves that build over time. You don't need to start with a fortune. Whether it's $50, $100, or $500 a month, it all adds up, and eventually, it snowballs. In this video, I'll show you and Josh exactly how to start building your own passive income streams, even if you're starting from scratch. I'll show you how to make your money work for you step by step. I will show you how to select Buffett criteria stocks in minutes, and in the end, I will show you a $9 per day investment plan into a portfolio that can grow into a $2.5 million valuation and pay $5,000 per month in dividend income. So grab a pen and paper, sit back, and let's get into it. Why it matters. Relying only on a job is risky. Companies lay off workers, economies shift, and inflation slowly eats away at savings. Even if you're a disciplined saver, growing wealth fast enough to keep up with rising costs is tough. That's where passive income steps in. It keeps paying you even when you're not actively working. One of the most powerful tools for this? Dividend stocks. These are shares of solid, well-established companies that pay you a piece of their profits regularly. And here's the magic. If you reinvest those dividends, they start earning money too. Over time, this compounding effect turns small investments into significant wealth. The best part? You don't need thousands to start. You can begin with just a few dollars and let time do the heavy lifting. Whether you want to supplement your income, save for retirement, or gain financial freedom, passive income gives you options and control over your future. The sooner you start, the more your money can grow. My goal for this video is simple: to arm you with the tools so that by the end, you will be able to start investing and select stocks for your own portfolio that can turn a $9 daily investment into a $2.5 million portfolio and generates $5,000 in monthly dividend income for retirement. So, let's understand the basics of stocks. Stocks are one of the most effective tools for building wealth and generating passive income. At their core, stocks represent ownership in a company. When you purchase a stock, you become a partial owner of that business, giving you a share in its earnings. This success can come in two primary forms: capital appreciation and dividends. Capital appreciation occurs when the value of the company, and therefore the price of the stock, increases over time. For example, if you buy a stock for $50 and its price grows to $100, your investment has doubled in value with capital appreciation, totaling $50 extra. Dividends, on the other hand, are payments made by companies to their shareholders, typically as a portion of their profits. These payments, which often occur quarterly, provide a steady income simply for holding the stock. Stocks are traded on exchanges like the New York Stock Exchange or NASDAQ, where buyers and sellers interact to determine stock prices. The value of a stock fluctuates based on supply and demand, which are influenced by factors such as the company's financial performance, market trends, and investor sentiment. While these price changes can create opportunities for growth, they also introduce risks. The market is inherently volatile, which means prices can drop unexpectedly. However, for long-term investors, this short-term volatility often smooths out, allowing the potential for steady gains over time, something I will show you later on. Dividend-paying stocks are particularly appealing for building passive income. Dividends are not only a reward for owning shares, but also a powerful tool for compounding wealth. Companies that pay dividends are often financially stable and established, making them attractive for those looking to generate income. Many of these companies also have a history of increasing their dividend payouts annually, meaning your income can grow over time without additional investments. This concept of dividend growth is essential for building long-term wealth, as it ensures that your passive income keeps up with inflation and continues to increase in value. Reinvesting dividends is one of the most effective ways to accelerate the growth of your portfolio. Instead of taking the dividend payouts as cash, reinvesting them allows you to purchase additional shares of the same stock. This creates a compounding effect where you earn dividends on the dividends you've reinvested. Over time, this snowball effect significantly increases both your portfolio's value and the income it generates. The longer you allow this process to work, the more powerful the results become. To see the potential of dividend investing, let's consider a real-world example. If you invest $10,000 in Prologis Incorporated, a dividend-paying stock with a 3.17% dividend yield and an average dividend growth rate of 11.27%, over 30 years, that investment grows substantially. After the first year, your portfolio increases to $11,000, earning $300 in annual dividends. After 10 years, it grows to $35,000, generating $1,100 in dividends annually. By year 30, your portfolio reaches $484,000, and your annual dividend income climbs to $19,600, or approximately $1,600 per month. This growth is the result of combining dividend reinvestment with the stock's price appreciation and annual dividend increases. What starts as a modest investment evolves into a substantial income source over time thanks to the power of compounding. In the end, I will show you a portfolio of stocks that will help you reach a $2.5 million valuation and earn $5,000 in monthly dividend income, all with just a $9 per day investment. One of the best aspects of dividend investing is its accessibility. You don't need to be wealthy to get started. Many brokerages allow you to invest in fractional shares, meaning you can begin with as little as $5 or $10. The key is consistency. Regularly adding to your investments, reinvesting dividends, and giving your portfolio time to grow. While the returns may seem small initially, the compounding effect magnifies those results exponentially over the years. Dividend investing is not about trying to predict market movements or chase high-risk gains. Instead, it's about focusing on quality companies with a history of paying and growing dividends. These stocks provide a consistent income stream even during market downturns and offer the opportunity for long-term growth. By understanding how stocks work and how to leverage dividends effectively, you can create a reliable strategy for building passive income. This foundational understanding of stocks, what they are, how they generate income, and how to harness their potential lays the groundwork for a successful investment journey. But before searching the stocks, let's understand the stock market mechanics. Let's start with ticker symbols, which are an essential part of the stock market. They serve as short codes or nicknames used to identify companies. For instance, Home Depot's ticker symbol is HD, and Coca-Cola's is KO. These abbreviations are found everywhere, from broker platforms to financial news sites, making it easier to locate and track specific stocks without typing out the company's full name. Every time you search for a stock, you'll rely on its ticker symbol to pull up the relevant information quickly and efficiently. Once you've identified a stock, the next step is understanding how to buy or sell it. This is where market orders and limit orders come into play. A market order is the simplest and fastest way to execute a trade. It allows you to buy or sell shares immediately at the current market price. This speed and simplicity make it a popular choice for many investors. However, because market prices can fluctuate quickly, you may end up paying slightly more or selling for slightly less than you initially expected. These small discrepancies happen because the market matches your order with the best available price at that moment, which might shift as your order is processed. Limit orders, on the other hand, provide more control over the price at which you buy or sell. With a limit order, you set a specific price, and the trade will only execute if the stock reaches that price. For example, if you want to buy shares of a stock but only if its price drops to $50, you can place a limit order at $50. If the stock's price doesn't reach your target, the trade won't go through. This precision can be advantageous, especially when you're looking to avoid overpaying or underselling. However, limit orders require patience, as there's no guarantee the stock will hit your desired price. It's a trade-off between control and immediacy, and the choice depends on your investment strategy. Another critical concept in the stock market is understanding bid and ask prices. When you look up a stock on your broker's platform, you'll see two numbers, the bid and the ask. The bid is the highest price that buyers are currently willing to pay for the stock, while the ask is the lowest price that sellers are willing to accept. The difference between these two numbers is known as the spread. The size of the spread can provide valuable insights into the stock's liquidity and how easily it can be bought or sold. A narrow spread usually indicates high liquidity, meaning there are many buyers and sellers actively trading the stock. This makes it easier to enter or exit a position without significantly impacting the price. Stocks of large, well-established companies like Apple or Microsoft typically have tight spreads and high liquidity because they are frequently traded. Conversely, a wider spread may suggest lower liquidity, which can make it harder to execute trades without affecting the stock's price. This is more common in smaller or less popular stocks where trading activity is lower. Understanding these dynamics is crucial for navigating the stock market effectively. These tools allow you to tailor your trades to your goals, whether you prioritize speed, precision, or cost efficiency. For instance, if you're investing in a stock with high liquidity, a market order might be the quickest and easiest option. On the other hand, if you're targeting a specific entry point or trading a less liquid stock, a limit order provides the precision needed to optimize your trade. These decisions are not made in isolation. The type of order you use and the stocks you choose depend on your overall investment strategy. Factors such as your financial goals, risk tolerance, and market conditions play a role in shaping these decisions. For example, long-term investors who prioritize consistency and stability might focus on highly liquid stocks with narrow spreads, while more opportunistic traders may use limit orders to capitalize on short-term price movements. The stock market is built on a series of interconnected mechanics, each designed to facilitate the buying and selling of shares. By understanding ticker symbols, order types, and bid-ask dynamics, you gain the knowledge to make informed decisions. This foundation prepares you to dive deeper into stock analysis and investment strategies, allowing you to confidently navigate the market and work toward your financial goals. Key ratios and metrics for analyzing stocks. However, investing in the stock market isn't just about buying shares of a company and hoping for the best. To make informed decisions, you need to understand how to evaluate a company's financial health and growth potential. This is where key financial ratios and metrics come into play. These tools give you insights into a company's performance, allowing you to determine whether it's a worthwhile investment. Later on, we will show you how Buffett uses these tools to find stocks for his portfolio, and I will also show you a real-life stock and create a portfolio using Buffett's criteria. One of the most commonly used metrics is the price-to-earnings, or PE ratio, which measures how much investors are willing to pay for a company's earnings. It's calculated by dividing the current stock price by the company's earnings per share, or EPS. A high PE ratio might indicate that investors expect strong future growth, while a low PE ratio could suggest the stock is undervalued or that the company faces challenges. However, the PE ratio should always be compared to other companies in the same industry for context. For example, a tech company will typically have a higher PE ratio than a utility company due to its growth potential. Another critical metric is the dividend yield, which measures how much income you can expect from a stock in relation to its price. Dividend yield is calculated by dividing the annual dividend per share by the current stock price. For example, if a company pays an annual dividend of $2 per share and its stock price is $50, the dividend yield is 4%. Dividend yield is especially important for investors focused on generating passive income. A high yield can be attractive, but it's essential to ensure the company can sustain its dividend payments over the long term. Don't chase overly high dividend yields like 10% or 15%. These are usually dividend traps, and companies typically cannot sustain these inflated dividends for long. A good rule of thumb is to avoid yields over 6 to 7%. The debt-to-equity, or DE ratio, is another important tool for analyzing a company's financial health. It measures how much debt the company has relative to its equity and is calculated by dividing total liabilities by total shareholder equity. A lower DE ratio is generally preferred as it indicates the company isn't overly reliant on borrowing to finance its operations. However, some industries, like utilities, naturally have higher debt levels, so it's crucial to consider the context of the sector when interpreting this metric. Return on equity, or ROE, is a measure of how efficiently a company generates profits from its shareholders' equity. It's calculated by dividing net income by shareholder equity. A higher ROE indicates that the company is effectively using its resources to generate profits, making it an attractive investment. Like the PE ratio, ROE should be compared within the same industry to assess how a company stacks up against its competitors. The earnings per share, or EPS metric, is a snapshot of a company's profitability. It's calculated by dividing the company's net income by the number of outstanding shares. EPS is a straightforward way to evaluate a company's earnings power on a per-share basis. Companies with consistently growing EPS are generally seen as strong investments, as it reflects their ability to increase profits over time. While these ratios provide valuable insights, they shouldn't be used in isolation. Combining multiple metrics paints a clearer picture of a company's financial health. For example, a company might have a high dividend yield, but if its DE ratio is also high, it could indicate that the company is using excessive debt to maintain its dividend payments. Similarly, a low PE ratio might suggest that a stock is undervalued, but it could also be a sign of underlying problems within the company. To make analyzing these metrics more accessible, there are tools and platforms like Seeking Alpha, FinChat, Yahoo Finance, Morningstar, and brokerage platforms that offer detailed financial data for stocks. These resources often present ratios and metrics in an easy-to-read format, allowing you to compare companies and track trends over time. For instance, you can use these tools to see how a company's PE ratio has changed over the years or to monitor its dividend growth history. Another important consideration is how these metrics vary across industries. For example, tech companies often prioritize growth over dividends, so their PE ratios will be higher and dividend yields lower. Conversely, utility companies are known for their stable dividends and lower growth rates, making metrics like dividend yield and DE ratio more relevant when evaluating them. Understanding these industry-specific nuances can help you better interpret financial data and make more informed investment decisions. As you begin analyzing stocks, keep in mind that no single metric tells the whole story. A company with a strong PE ratio might look appealing at first glance, but if its DE ratio is high and its ROE is weak, it could be a risky investment. The goal is to look for companies with a balanced financial profile, strong profitability, sustainable debt levels, and a history of rewarding shareholders. Right now it might sound confusing, but in a couple of minutes, I will explain with a real stock and you will see how easy it is to follow. Stick around. Analyzing stocks using these key ratios and metrics is a critical step in building a solid investment strategy. By understanding how to interpret this data, you'll be able to identify companies with strong fundamentals and avoid those that might pose unnecessary risks. This approach not only helps you make smarter investment choices, but also gives you the confidence to navigate the stock market with a long-term perspective. Now, let's understand the economic sectors. The stock market is vast, and understanding economic sectors is essential for navigating it effectively. Economic sectors group companies based on the type of business they conduct or the industry they operate in. This classification helps investors diversify their portfolios and identify opportunities across different areas of the economy. By knowing how sectors perform during various market conditions, you can make more informed decisions and reduce overall investment risk. There are 11 primary economic sectors, each representing a distinct area of the economy. These include technology, healthcare, consumer discretionary, consumer staples, energy, financials, industrials, materials, real estate, communication services, and utilities. Each sector plays a specific role in driving the economy, and their performance can vary depending on factors like economic cycles, government policies, and technological advancements. For instance, the technology sector, which includes companies like Apple and Microsoft, tends to thrive during periods of innovation and consumer demand for digital products and services. Meanwhile, sectors like utilities or consumer staples, companies providing essential goods and services, often perform well during economic downturns because they supply necessities that people continue to purchase regardless of financial conditions. One of the key reasons to understand sectors is to achieve diversification. Diversification involves spreading your investments across different sectors to reduce the impact of poor performance in any one area. For example, if you invest heavily in technology stocks and the sector faces a downturn, your portfolio could take a significant hit. However, if your investments are also spread across sectors like healthcare, energy, and utilities, the losses in one area will be offset by gains in another. Diversification helps stabilize your returns over time and makes your portfolio less vulnerable to market volatility. Sectors are also categorized based on how they respond to economic conditions. Cyclical sectors such as technology, industrials, and consumer discretionary tend to do well when the economy is growing. These sectors are highly sensitive to consumer spending and economic activity, which means their performance often mirrors the health of the economy. During periods of economic expansion, cyclical sectors see increased demand, higher revenue, and rising stock prices. However, during recessions, these sectors are often hit hardest as consumer spending declines. On the other hand, defensive sectors, such as healthcare, utilities, and consumer staples, are more stable and less affected by economic cycles. These sectors provide essential goods and services that people need regardless of the economic climate. For instance, consumers will continue to buy groceries, use electricity, and seek medical care even during a recession. As a result, defensive sectors are often seen as safe havens for investors during periods of economic uncertainty. They may not deliver rapid growth like cyclical sectors, but they offer consistent performance and steady returns, making them valuable for risk-averse investors. Sector-specific investing can also help you align your portfolio with your financial goals and risk tolerance. If you're seeking long-term growth, sectors like technology and healthcare may be attractive due to their innovation-driven nature and potential for high returns. For example, advancements in artificial intelligence or biotechnology could lead to significant growth in these areas. Conversely, if you prioritize income and stability, sectors like utilities and consumer staples are worth considering because they often feature companies with consistent dividend payouts. Understanding sectors also allows you to capitalize on trends and shifts in the economy. For example, the energy sector has experienced significant changes with the rise of renewable energy and the global push towards sustainability. Investors who identify these trends early can position themselves to benefit from long-term growth opportunities. Similarly, the real estate sector, which includes real estate investment trusts or REITs, provides an opportunity to invest in income-generating properties without directly owning physical real estate. While investing across sectors offers diversification, it's important to monitor how your investments perform over time. Economic conditions and market dynamics are always changing, and some sectors may become more or less attractive depending on the environment. Regularly reviewing your portfolio and rebalancing as needed can help you maintain an optimal mix of investments that aligns with your goals. For example, if you notice that a cyclical sector like technology has grown disproportionately in your portfolio due to strong performance, you might consider trimming your holdings in that sector and reallocating to defensive sectors like healthcare or utilities. This ensures that your portfolio remains well-balanced and protected against potential downturns. Understanding how sectors operate and respond to market conditions can help you build a more resilient portfolio. Whether your focus is on growth, income, or stability, a sector-based approach allows you to allocate your investments strategically to achieve your financial goals. Diversification across sectors not only reduces risk, but also positions you to benefit from opportunities in different areas of the economy. But for that, planning is a must, so let's understand the planning for market swings. The stock market is unpredictable, filled with corrections, recessions, and bear markets. These swings may seem alarming, but they are temporary. Over time, markets recover and often grow beyond their previous highs. This recovery is the cornerstone of long-term investing. It's not about predicting when the next dip will happen. It's about having a strategy, staying consistent, and making volatility work in your favor. Emotions can be an investor's worst enemy during market highs and lows. When the market is climbing, it's easy to chase rising stocks out of fear of missing out, often buying at inflated prices. Conversely, when markets fall, panic often leads to selling at a loss, locking in what might have been a temporary decline. The key is to remain rational and avoid reacting emotionally. Long-term success in investing comes from keeping your focus on your strategy and resisting the urge to follow the crowd. A strong defense against volatility is a well-diversified portfolio. By spreading your investments across various sectors and asset types, you reduce the impact of any single investment's poor performance. For example, pairing growth stocks with dividend-paying stocks and bonds creates balance. When a high-growth stock in the technology sector experiences a downturn, the steady income from dividend stocks or the stability of bonds can cushion your portfolio. Diversification ensures no single event derails your overall investment plan. Another powerful strategy for managing market swings is dollar-cost averaging. This strategy involves investing a fixed amount of money at regular intervals, regardless of market conditions. Instead of stressing over the perfect time to invest, you invest a fixed amount at regular intervals, regardless of market conditions. This strategy helps you buy more shares when prices are low and fewer shares when prices are high, which averages out your cost over time and reduces risk. For example, let's say you invest $200 every month into a stock. In month 1, the stock price is $50 per share, so you buy 4 shares. In month 2, the stock drops to $40 per share, so you buy 5 shares. In month 3, the stock rises to $66 per share, so you buy 3 shares. Since you're buying at different prices, your average cost per share is lower than the highest price you paid. Instead of dumping all your money in at once and risking a bad price, DCA smooths out the ups and downs, keeping your investment steady and reducing market stress. But managing market swings isn't just about keeping emotions in check. It's also about overcoming analysis paralysis. With so much information available, it's easy to get stuck researching and second-guessing every decision. You might spend hours reading about stocks, strategies, and trends, but hesitate to make a move. Perfect knowledge doesn't exist, and there's always some level of uncertainty in investing. The solution is simple. Start small. Making your first investment, even if it's just $10, is more valuable than endless research. Taking action builds confidence, and as you gain experience, you'll develop a better understanding of markets and patterns. Small, consistent actions are the foundation of successful investing. Think of it like building strength in the gym. You don't start with the heaviest weights. You begin with manageable ones and gradually increase as you build confidence. Investing works the same way. Starting small allows you to learn without feeling overwhelmed, and over time, you'll grow comfortable navigating market ups and downs. Not only that, but consistency beats perfection every time. Many new investors waste time searching for the perfect stock or waiting for the right moment to enter the market. The truth is, waiting for perfection often leads to missed opportunities. What truly matters is contributing regularly to your portfolio. Whether you're investing $20, $100, or $500, staying consistent will yield better results over time than trying to time the market. Each contribution adds momentum, allowing compounding to work its magic. Market swings also present opportunities. Downturns, while intimidating, often allow you to buy quality stocks at discounted prices. Having a plan in place, such as maintaining a cash reserve for these moments, lets you capitalize on these opportunities instead of fearing them. These dips are when disciplined investors often see the greatest rewards. In investing, doing something, even if it's small, is far better than doing nothing. A clear plan, rational decision-making, and consistent actions are all you need to handle market swings effectively. Dividend investing, building consistent income. What sets dividend investing apart is its dual benefit. Not only do you receive regular income through dividends, but many dividend-paying companies also experience stock price appreciation over time. These companies are typically well-established and financially stable, with a strong history of profitability. For example, businesses in sectors like utilities, consumer staples, and healthcare are often known for their consistent dividend payouts. These companies generate steady cash flows even during economic downturns, making them reliable choices for investors looking to weather market volatility. The concept of dividend growth is another critical component of this strategy. Dividend growth refers to companies that not only pay dividends consistently, but also increase their payouts year after year. This growth is vital for protecting your income against inflation, ensuring that your purchasing power doesn't erode over time. For example, if you own a stock that pays a dividend of $2 per share today and increases it by 5% annually, that dividend will grow to $3.21 per share in 10 years. This raise in your passive income occurs without requiring any additional investment from you. One of the biggest advantages of dividend investing is reinvestment. Instead of cashing out your dividends, you can use them to buy more shares of the same stock. This leads to compounding, where your new shares also earn dividends, which then buy even more shares, and the cycle continues. For example, let's say you own 100 shares of a stock that pays $1 per share in dividends each year. That means you earn $100 in dividends. Instead of taking the cash, you reinvest it and buy more shares. Next year, you'll have more shares earning even more dividends. Over time, this snowball effect can turn a small investment into a massive passive income stream. Many brokerages offer automatic dividend reinvestment plans, or DRIPs, making it easy to set and forget, so your money keeps growing without extra effort. In the end, I will show you how this DRIP strategy can turn a $9 daily investment into a $2.5 million portfolio that pays $5,000 in dividend income every month. Developing your investing strategy. Investing isn't a one-size-fits-all journey. Your financial goals, risk tolerance, and timeline will shape the investing strategy that works best for you. Developing a well-thought-out plan tailored to your unique needs is critical to achieving consistent growth and building long-term wealth. One of the most established strategies is value investing, which involves identifying undervalued stocks trading below their intrinsic value. These stocks might be overlooked by the market due to temporary setbacks or broader market trends. Value investors like Warren Buffett look for strong companies with solid fundamentals, such as low debt, consistent earnings, and a competitive advantage, but whose stock prices don't reflect their true worth. The key to value investing is patience. You're betting that the market will eventually recognize the stock's true value, leading to substantial gains. Growth investing, on the other hand, focuses on companies that are expected to grow their revenues and earnings at a faster rate than the market average. These companies often reinvest their profits into expanding their business rather than paying dividends. Think of tech giants like Amazon or smaller startups revolutionizing industries. Growth stocks often have higher price-to-earning ratios, reflecting investors' optimism about future potential. While growth investing can deliver impressive returns, it comes with higher risk, as these stocks can be more volatile and may underperform during economic downturns. For those looking for a more hands-off approach, passive investing is an excellent option. Passive investing focuses on tracking the performance of a broader market index, such as the S&P 500, through exchange-traded funds or ETFs or index funds. These funds offer instant diversification, low fees, and consistent performance over time, making them a popular choice for long-term investors. Rather than picking individual stocks, passive investors rely on the overall growth of the market, which historically has delivered strong returns. This strategy is ideal for individuals who want steady growth without the time and effort of researching individual companies. Dividend investing is another widely adopted strategy, particularly for those seeking regular passive income. This approach focuses on investing in companies that pay consistent and often growing dividends. Dividend-paying stocks, such as those in the utilities or consumer staple sectors, provide a steady income stream while also offering the potential for capital appreciation. Reinvesting dividends can amplify returns through the power of compounding. Dividend investing is particularly appealing for retirees or those looking to create a predictable income stream without selling off their assets. For experienced investors willing to embrace risk, volatility investing can be an exciting and profitable strategy. This approach involves taking advantage of price fluctuations in highly volatile stocks or sectors. Volatility investors often use options, leveraged ETFs, or other financial instruments to profit from short-term movements. While this strategy can deliver high returns, it requires a deep understanding of market dynamics and the ability to act quickly. It's not recommended for beginners or those with low risk tolerances, as losses can accumulate rapidly. Selecting the right strategy depends on your individual financial goals and comfort with risk. If your goal is to build wealth slowly and steadily, passive investing or dividend investing may be the best fit. These strategies emphasize long-term growth and stability, making them suitable for risk-averse investors or those new to the stock market. On the other hand, if you're aiming for higher returns and are comfortable with more risk, value or growth investing might align better with your objectives. For those looking to take advantage of short-term opportunities, volatility investing offers an advanced, albeit risky, approach. Diversification is essential. Regardless of your chosen strategy, combining different approaches can help you balance risk and reward while taking advantage of various market opportunities. For example, you might allocate a portion of your portfolio to dividend-paying stocks for stability and passive income, invest in growth stocks for higher returns, and hold ETFs for broad market exposure. This mix allows you to capitalize on the strengths of multiple strategies while mitigating the weaknesses of any single approach. Setting clear, measurable goals is another important step in developing your strategy. Ask yourself what you want to achieve with your investments. Are you saving for retirement, building an emergency fund, or creating passive income? For this video, I will be combining value investing with a dividend investing strategy. I will show you how Buffett selects his stocks. In the end, I will show you a portfolio of stocks that will help you reach a $2.5 million valuation and earn $5,000 in monthly dividend income, all with just a $9 per day investment. Developing your investing strategy is a personal journey. Whether you're aiming for slow, steady growth, consistent income, or high-risk, high-reward opportunities, the key is to stay disciplined and aligned with your financial goals. With the right plan, a commitment to consistency, and a willingness to adapt, you can build a portfolio that not only meets your needs, but also grows with you over time. With all that, let's shift our focus to stock selection criteria, which is based on Buffett's 5 rules of thumb, which combines dividend investing and value investing strategies. To understand this, you need to understand some basics about the balance sheet. The balance sheet is one of the most valuable tools for analyzing a company's financial health. It provides a snapshot of everything a business owns, assets, owes, liabilities, and what's left for shareholders, equity. At its core, the balance sheet follows a simple equation: assets equals liabilities plus shareholders' equity. This equation shows how a company funds its operations, whether through borrowing, liabilities, or investment from shareholders, equity. For Warren Buffett, the balance sheet shows a company's true financial position, how stable it is, how much it relies on debt, and how effectively it reinvests profits. Over decades of investing, Buffett developed 5 simple yet powerful rules of thumb to evaluate balance sheets and identify companies built to last. Why these rules matter. Each rule serves a unique purpose, but together they provide a holistic view of a business. At the heart of this strategy is a focus on long-term stability, resilience, and growth. Buffett doesn't just look for companies that perform well in good times, he seeks businesses that can weather economic downturns and emerge stronger. Let's explore these rules in detail. The first and most fundamental rule is having more cash than debt. A company's total cash and short-term investments should exceed its long-term debt, ensuring financial flexibility and resilience. Businesses with strong cash reserves can navigate economic downturns, invest in growth, and operate independently without the burden of excessive debt. In contrast, companies with high debt levels may struggle during recessions, as interest payments and liabilities can hinder their ability to stay afloat. Closely related to this principle is maintaining a low debt-to-equity ratio. Buffett prefers companies with a DE ratio below 0.8, as it indicates financial discipline and a sustainable capital structure. Excessive reliance on debt makes businesses vulnerable to economic volatility and rising interest rates. While industry norms vary, utilities often carry higher debt than technology firms. A company operating within a reasonable range for its sector demonstrates prudent financial management. Another key criterion is avoiding preferred stock. Preferred stock, a hybrid of debt and equity, is often issued by companies in need of financing but unwilling to take on traditional loans. Buffett sees this as a red flag, suggesting financial instability. Strong businesses generate sufficient profits and secure funding through equity financing rather than resorting to expensive alternatives like preferred stock. Beyond financial stability, Buffett also looks for positive retained earnings growth. Retained earnings represents the profits a company reinvests after distributing dividends. Companies that consistently grow their retained earnings, even during economic downturns, exhibit resilience and profitability. This metric signals an ability to reinvest in innovation, expansion, and long-term value creation. And finally, Buffett views the presence of treasury stock, shares repurchased by the company, as a positive indicator when executed strategically. Thoughtful stock buybacks signal management's confidence in the company's value and demonstrate a surplus of cash. By reducing the number of outstanding shares, buybacks increase the value of remaining shares, ultimately benefiting long-term shareholders. Warren Buffett's 5 rules of thumb for analyzing a company's balance sheet are more than theoretical. They are practical tools that can be applied to real-world examples to evaluate a company's financial health. Now, let's apply these rules to a real-life company and see if it is a good fit for our portfolio. I am taking Microsoft Corporation with ticker symbol MSFT as an example. A globally renowned technology company with one of the strongest balance sheets in the market. By walking through each of Buffett's rules, you'll see how they highlight Microsoft's financial strengths and if the company aligns with Buffett's long-term investment philosophy. Buffett's first rule is simple yet powerful. A company's total cash and short-term investments should exceed its long-term debt. This ensures the company has sufficient liquidity to weather economic downturns, fund innovation, and seize growth opportunities without over-reliance on borrowing. For that, search FinChat. Go to Balance Sheet. As of its latest balance sheet, the company holds $78.4 billion in total cash and short-term investments, compared to $42.9 billion in long-term debt. That's a cash-to-debt ratio of nearly 1.8, meaning Microsoft has nearly twice as much cash as debt. This financial position gives Microsoft unparalleled flexibility. It can pursue strategic acquisitions, invest in groundbreaking technologies, or navigate uncertain economic conditions without taking on additional debt. Furthermore, this liquidity minimizes the company's vulnerability to interest rate hikes or financial strain during market downturns. For investors, Microsoft's adherence to Buffett's first rule signals a rock-solid foundation for long-term stability. Buffett's second rule is low debt-to-equity ratio. The debt-to-equity ratio measures how much of a company's funding comes from debt compared to shareholder equity. Buffett favors a ratio below 0.8, as it reflects financial discipline and reduced reliance on borrowing. Go to Ratios and click on Financial Health. Here you will see debt-to-equity ratio. Microsoft excels here, with a debt-to-equity ratio of 0.3, far below Buffett's threshold. This means the company primarily finances its operations through equity rather than debt. For investors, a low DE ratio is crucial because it indicates that the company is not over-leveraged and can sustain growth without accumulating excessive liabilities. It also reduces risks associated with rising interest rates or economic downturns, where companies with high debt often struggle. Microsoft's DE ratio reflects a disciplined and sustainable financial structure, making it a standout in this category. Third rule is no preferred stock. It is a hybrid financing tool that combines elements of debt and equity. Companies issue preferred stock when they need funding but don't want to take on traditional loans. However, Buffett views this as a red flag because it often signals financial weakness or inefficiency in raising capital. Microsoft's balance sheet shows no preferred stock, listed in the equity section, aligning perfectly with Buffett's standards. This absence reflects the company's financial strength and independence. Rather than relying on costly or unconventional financing methods, Microsoft raises capital through retained earnings or common equity. The lack of preferred stock also aligns with Buffett's preference for businesses that operate from a position of stability and confidence. For investors, this reinforces Microsoft's reputation as a financially sound company that doesn't compromise its balance sheet integrity. Once again, Microsoft comfortably passes Buffett's third rule. Fourth is positive retained earnings growth. It represents the profits a company reinvests into its business after paying dividends. Buffett views consistent growth in retained earnings as a critical indicator of profitability and resilience, particularly during challenging economic periods. Microsoft's retained earnings tell a compelling story of consistent and robust growth. In 2020, the company reported retained earnings of $34.6 billion. By 2023, this figure had grown to $118.8 billion, and most recently, it stands at an impressive $188.9 billion. This upward trajectory highlights Microsoft's ability to generate substantial profits and reinvest them strategically into its operations, innovation, and future growth. Even during periods of economic uncertainty, Microsoft has maintained this growth, showcasing its resilience and smart financial management. For investors, retained earnings growth is a sign of a forward-thinking company that prioritizes long-term value creation. Microsoft passes this rule with flying colors. The last rule is the presence of treasury stock. It refers to shares that a company has repurchased from the market. Share buybacks are often seen as a sign of confidence, signaling that management believes the company's stock is undervalued and wants to return value to shareholders. Buffett appreciates companies with treasury stock as it reflects shareholder alignment. Interestingly, Microsoft reports no treasury stock on its balance sheet. While this might seem like a deviation from Buffett's preferences, Microsoft takes a different approach to rewarding shareholders. Instead of focusing heavily on buybacks, the company prioritizes consistent dividend payments and strategic investments in growth opportunities. This balanced strategy ensures that Microsoft delivers value to shareholders while maintaining its financial flexibility and avoiding the risks associated with excessive buybacks. For Buffett, the absence of treasury stock doesn't disqualify Microsoft. Instead, it highlights the company's disciplined financial management and focus on sustainable growth. By balancing shareholder returns with long-term investments, Microsoft aligns with the principles underlying Buffett's fifth rule. Now, by understanding the rules of Buffett, let's select the remaining 4 stocks and build a portfolio. Building a portfolio to generate passive income. Building a portfolio that generates $5,000 in monthly dividend income requires a strategic combination of high-quality dividend stocks, consistent reinvestment, and a focus on long-term growth. By applying Warren Buffett's rules for balance sheet analysis, I have shortlisted 5 companies that stand out for their financial health, growth potential, and commitment to shareholder returns. These stocks, when combined, create a well-diversified portfolio that balances dividend income with significant capital appreciation. The first stock in this portfolio is Prologis, with the ticker symbol PLD, a leader in logistics and industrial real estate. Its properties are the backbone of modern supply chains, serving some of the world's largest companies as they store and move goods efficiently. Prologis is known for its strong dividend performance, underpinned by a business model that thrives on long-term lease agreements with high-quality tenants. As e-commerce continues to expand, the demand for Prologis' properties remains strong, making it a reliable player for steady income and growth. Prologis offers a strong dividend yield of 3.17%, a steady dividend growth rate of 11.27%, and an annual share price appreciation of 9.95%, making it a reliable choice for consistent income. Next, Microsoft Corporation with the ticker symbol of MSFT. I added this because 1. It is one of the most innovative and dominant technology companies in the world, and second, we just saw it check Buffett's all 5 criteria for a perfect long-term stock. Known for its software products like Windows and Office, as well as its cloud computing platform Azure, Microsoft has built a robust ecosystem that spans business, consumer, and enterprise solutions. Its consistent dividend payouts reflect the company's commitment to returning value to shareholders while maintaining a focus on growth through reinvestment in groundbreaking technologies. Microsoft's strong financial foundation and ability to innovate make it an anchor for any long-term investment portfolio. Microsoft's dividend yield of 0.75% may seem modest, but its impressive dividend growth rate of 10.35%, coupled with an annual share price appreciation of 21.57%, ensures exceptional returns over time. Another strong addition is NetEase with the ticker symbol of NTES. It is a major player in the Chinese technology sector, focusing primarily on gaming, online education, and e-commerce. Its diversified portfolio of digital services and its leadership in mobile gaming makes it a compelling growth story. NetEase has consistently rewarded investors with dividends, which are supported by the company's strong revenue growth and expansion into emerging industries. With its commitment to innovation and market dominance in its niches, NetEase is well positioned to deliver long-term value. NetEase combines a dividend yield of 2.4% with a dividend growth rate of 17.29% and an annual share price appreciation of 16.9%, making it an excellent choice for balancing income and growth. Federal Agricultural Mortgage Corp Class C with the ticker symbol of AGM, also known as Farmer Mac, provides credit to the agricultural sector, helping farmers in rural communities access the financing they need. Farmer Mac operates in a vital sector that is often overlooked but essential to the economy. Its focus on agricultural loans ensures steady cash flow and low-risk lending practices, making it a stable and dependable choice for dividend investors. Farmer Mac's strong financial management and emphasis on growth in rural America reinforce its value as a long-term income generator. With a dividend yield of 2.82%, an impressive dividend growth rate of 25.89%, and an annual share price appreciation of 17.35%, it delivers both steady income and outstanding growth potential. Finally, Home Depot with the ticker symbol of HD is the largest home improvement retailer in the United States, catering to both professional contractors and DIY enthusiasts. With a vast network of stores and an ever-growing online presence, Home Depot continues to benefit from the ongoing demand for home renovation and construction projects. Its consistent dividend payments are backed by a solid track record of profitability and growth, reflecting the company's ability to adapt to changing consumer needs. Home Depot's reliable business model and leadership in its sector make it a valuable component of this portfolio. With a dividend yield of 2.12%, a dividend growth rate of 16.95%, and an annual share price appreciation of 13.8%, Home Depot provides consistent income and stability. Each of these stocks plays a unique role in building a balanced, high-growth dividend portfolio. Prologis provides stable real estate-backed income fueled by e-commerce expansion. Microsoft offers innovation-driven growth with steady dividends and market dominance. NetEase adds high-growth potential in the booming tech and gaming sectors. AGM ensures steady cash flow from the essential agricultural finance industry. Home Depot contributes resilient consumer-driven stability with consistent dividend growth. Together, they create a diversified portfolio, blending dividend security, capital appreciation, and sector-specific growth to maximize long-term returns. When combined, these 5 companies create a powerful portfolio with a current dividend yield of 2.25%, an average dividend growth rate of 16.35%, and an annual share price appreciation of 15.91%. Now that you have made a portfolio, it's time to know how much it can pay after applying all the strategies we have discussed so far. Let's say you or Josh invest $9 a day into this portfolio. Here's how it's expected to grow over time. In the first year, your daily investment would accumulate to $3,285. By year 10, the portfolio will grow to $78,000, with dividends starting to make an impact. At this stage, compounding begins to accelerate, driving steady growth. Give it 10 more years, and by year 20, the portfolio will reach $498,000, with annual dividends climbing significantly, contributing a substantial portion to the reinvested growth. By year 30, the portfolio value will soar to $2,782,000, generating $60,000 annually, or about $5,000 per month in passive income. Reaching a $5,000 monthly dividend income target is no small feat, but this portfolio proves it is achievable with discipline and a long-term perspective. Each stock was chosen for its alignment with Buffett's rules, focusing on liquidity, low debt, profitability, and shareholder alignment. This ensures that the companies in the portfolio are built on strong financial foundations, capable of sustaining growth and weathering economic challenges. This portfolio not only meets its income goal, but also provides a blueprint for how strategic investing can deliver financial independence. By staying consistent, reinvesting earnings, and focusing on high-quality companies, you can create a portfolio that grows steadily and provides a reliable income stream for years to come. Here's a quick recap of how we've built a plan for achieving financial freedom through smart investing. We started with the basics, like understanding dividend stocks, key metrics, and how to evaluate companies using Buffett's timeless rules. From there, we explored strategies like value investing, passive investing, and dividend reinvestment, showing how they work together to grow wealth over time. Finally, we applied these principles to a real portfolio of 5 stocks, projecting it to grow into a $2.8 million powerhouse that generates nearly $5,000 in monthly passive income. In 1988, Warren Buffett made a $1 billion investment in Coca-Cola. Now that $1 billion has grown to over $20 billion, paying close to $1 billion in dividends every year without him adding another dime. How did he do it? Compounding. He let time, dividends, and reinvested growth turn an already substantial investment into a staggering fortune. Now, let's bring it closer to home. You might not have $1 billion to start with, but the principle works the same whether you have $100 or $1,000. In this video, I'll show you and Josh a step-by-step process of what compounding is, how it works, and most importantly, in the end, I will show you how you can select a tailor-made portfolio that will turn $10,000 into a portfolio worth over $1.2 million and pays over $10,000 in monthly dividend income. Compounding, the engine behind your wealth. Alright, let's first set a stage about how compounding actually works. If you're new to this, don't worry, I'll keep it short and simple. Compounding is one of the most powerful forces in building wealth. At its core, it's about earning returns on your returns. This isn't just about making money. It's about making your money work harder for you and Josh over and over again. The process starts slow, almost imperceptible, but over time, it accelerates into exponential growth. Here's how it works. Let's say you start with a $10,000 investment in a portfolio or a stock that grows at an 8% annual rate. In the first year, your portfolio grows by $800, bringing the total to $10,800. That growth might feel small, barely noticeable, but here's where the magic of compounding starts. In year 2, you're not just earning 8% on your original $10,000, you're also earning on the $800 you made in the first year. That's $864 added this time, bringing your portfolio to $11,664. In year 3, the process continues. Now your portfolio earns 8% on the entire $11,664. That's $933, and your total grows to $12,597. Notice what's happening? Every year, the amount added gets a little bigger, even though the growth rate is the same. That's because you're earning returns on both your original investment and the returns it has already generated. By year 10, this process has more than doubled your portfolio, growing it to $21,589. Now, the snowball is rolling faster. Every year, the growth is more noticeable as your portfolio's base gets larger and larger. By year 20, your portfolio value reaches $46,610, over 4 times your initial investment. Here's why. Those returns from earlier years, which seem small at first, have compounded into something substantial. By year 30, the growth becomes exponential. Your portfolio hits an impressive $100,627. The returns generated in just 1 year are close to $8,000, nearly your entire starting amount. That's what compounding essentially is. Small, consistent growth in the early years sets the stage for exponential returns later. The earlier you start, the bigger your snowball grows. Every reinvested dividend adds to the foundation, allowing future returns to grow larger and faster. But it's not just about dividends alone. Compounding begins exponentially stronger when combined with overall portfolio growth. Over time, the consistent reinvestment of dividends multiplies both the income and the value of the portfolio, making the results far more significant than they initially appear. In the end, I will show you how you can select a tailor-made portfolio that will turn $10,000 into a portfolio worth over $1.2 million and pay over $10,000 in monthly dividend income. Breaking down your financial snowball, dividends versus appreciation. While compounding is the driving force behind portfolio growth, it's the combination of 2 elements, dividends and capital appreciation, that fuels the financial snowball. Each of these components plays a critical role in building wealth over time. Dividends form the foundation. These are regular payments made by companies to shareholders, and when reinvested, they create a cycle of additional growth. Over the years, reinvested dividends steadily add to your portfolio's value, increasing your earning potential year after year. On the other hand, capital appreciation adds another layer. This refers to the increase in the value of the stocks or funds in your portfolio. As the companies you've invested in grow their earnings and market value, your portfolio benefits from this upward momentum. The true magic happens when these 2 forces, dividends and capital appreciation, combine. Reinvested dividends increase the number of shares you own, which in turn amplifies the effect of capital appreciation. Over time, these 2 elements feed into each other, driving exponential growth. Here the pie chart shows where dividends and capital appreciation contribute almost equally to the overall portfolio growth. Initially, dividends play a more prominent role, but as the portfolio matures, capital appreciation starts to take over, creating a balanced and robust growth trajectory. This synergy is what transforms a modest initial investment into a wealth-generating machine over the years, making dividends and appreciation 2 sides of the same powerful coin in your financial journey. But to make it work, you need the right dividend stocks. I'll show you how a tailored dividend portfolio can optimize this process, reducing the amount of time and capital needed to reach $10,000 to $15,000 in dividend income per month. Stock selection process. How to pick winners. Selecting the right stocks is critical for building a portfolio that grows consistently and generates reliable income. A well-chosen stock or fund can accelerate compounding, while a poor choice can hold you and Josh back. To create a high-performing portfolio, there are specific criteria and metrics to evaluate when picking your investments. When choosing a portfolio aimed at generating $10,000 to $15,000 in monthly passive income, strategic selection is key. To reach this financial goal, I focus on several key criteria that forms the backbone of my portfolio strategy. First, dividend yield is an essential consideration. While higher yields offer more immediate income, extreme yields can be unsustainable and risky. Companies paying unsustainably high dividends may reduce payouts if their financial situation weakens. I prioritize yields between 4% and 5%, which strike a balance between steady income and the potential for future growth. Next is the dividend growth rate, which reflects how much a company has been increasing its dividend payouts over time. A strong growth rate, ideally above 10%, signals a company's commitment to rewarding investors. This growth rate is critical for long-term compounding as it increases both income and portfolio value. The payout ratio is another crucial metric. A payout ratio below 60% ensures that a company has enough flexibility to reinvest in its growth while maintaining dividends. For companies in stable industries with predictable cash flows, higher payout ratios can be acceptable, but I prioritize those that leave room for reinvestment and stability. Lastly, diversification is vital to mitigating risk and maximizing returns. Including different asset types, such as real estate investment trusts, or REITs, dividend-focused ETFs, and high-growth stocks ensures exposure across sectors and reduces the impact of market volatility. Even with the best intentions, there are common mistakes to avoid. chasing extremely high yields or hot stocks can often lead to disappointment, as these investments are frequently unsustainable. Similarly, failing to do your due diligence, like analyzing a company's financials, market position, and payout ratios, can expose you to unnecessary risk. Next, I will show you and Josh a tailor-made portfolio that will turn $10,000 into a portfolio worth over $1.2 million and pay over $10,000 in monthly dividend income. Building the perfect dividend portfolio. Now that the selection criteria are clear, it's time to build a portfolio designed to generate $10,000 to $15,000 in monthly dividends while maintaining robust growth. The goal is to create a mix of high yield, high growth, and stable dividend stocks that compound consistently over time. This portfolio was built with 5 key stocks, each with a unique role in delivering reliable income and capital appreciation. At its core is Altria Group, with a ticker symbol MO, a dependable dividend stock with a remarkable dividend yield of 7.58%, a 10-year dividend growth rate of 7.29%, and an annual share price appreciation of 0.64%. Known for its consistent payouts, Altria forms the foundation of reliable income generation. Next is CubeSmart, with a ticker symbol CUBE, a leading REIT specializing in self-storage solutions. With a high yield of 4.88%, an impressive dividend growth rate of 14.65%, and an annual share price appreciation of 6.60%, CubeSmart combines stable income with significant growth potential, making it a critical player in this portfolio. Adding growth-oriented exposure is NetEase, with a ticker symbol NTES, which offers a moderate yield of 2.65%, but compensates with exceptional dividend growth at a 10-year CAGR of 17.29% and an annual share price appreciation of 16.45%. This stock's focus on technology and global expansion positions it for long-term appreciation. For additional balance, Home Depot with a ticker symbol HD provides a dividend yield of 2.29%, a strong dividend growth rate of 16.95%, and an annual share price appreciation of 14.23%. Its consistent performance in the home improvement sector ensures stability and steady compounding over time. Finally, the Schwab US Dividend Equity ETF with a ticker symbol SCHD rounds out the portfolio, offering diversification across multiple sectors. With a 3.64% dividend yield, a dividend growth rate of 11.04%, and an annual share price appreciation of 7.29%, this ETF ensures a steady income stream and exposure to a broad range of industries. Each stock in this portfolio serves a distinct purpose. MO provides a foundation of reliable income with its high yield and stable dividends. CubeSmart balances this with consistent growth and income stability from the self-storage sector. NTES injects growth potential, leveraging tech and global expansion for exceptional long-term appreciation. Home Depot ensures steady compounding and stability through its strong dividend growth and performance in the home improvement market. Lastly, SCHD diversifies the portfolio, balancing income and growth with exposure across multiple sectors for reduced risk. When combined, this portfolio achieves an average dividend yield of 4.21%, a dividend growth rate of 13.44%, and an annual share price appreciation of 9.04%. This balance ensures the portfolio generates consistent monthly income while steadily compounding value over time. Here's what happens if you and Josh invest $10,000 in this portfolio. Let's break down the portfolio performance analysis. In the first year, your $10,000 investment grows to $11,325, generating $421 in annual dividends. By year 10, the portfolio expands to $37,687, with dividends increasing to $1,586 annually, or about $132 per month. At this stage, compounding starts to show its effect, setting the portfolio on a steady growth path. By year 20, the portfolio value reaches $180,489, and annual dividends climb to $7,598, equating to $633 per month. This accelerated growth positions the portfolio closer to its ultimate target. By year 30, the portfolio hits its goal, reaching $1,236,074 in value and generating $12,220 monthly income. This progression shows the sheer importance of compounding. While growth starts gradually, it accelerates exponentially as the years pass. Early dividends lay the groundwork for future growth, and reinvested earnings amplify results to create an unstoppable financial snowball. Want to know the fastest way you can live off dividends and earn $2,800 in dividend income every month? Click the video on screen to find out.